This will get this will get posted to the cloud and it'll get posted on your dashboard. So thank you for saying that. I about messed up, but we have other ones that I've recorded in the past that are recorded, and I got to be honest, these are mostly all the same. You know, I say the same stuff over and over again. I use the same content over and over again, so it gets a little bit ad nauseum. Um, so again, my tips are don't uh, don't take the content for granted. Actually, go through uh, the material. Don't just click through it so you can get to the end. Um, really, really study it. Um, listen to videos, take practice exams. That's my big thing, is taking practice exams. That's what helps me the most, is taking practice exams. And then as you take those, it should pump out your where you're struggling, the sections that you have trouble with, will shift your focus of your study to those areas. So I know it's always nice to feel like you know what you know, and you stick in the stuff, to make you feel good, but you got to live in the areas that you're weak on in order to pass the test. So, but again, if you have the material that you know and that you're confident with really, really down, you're probably going to have enough of a curve to miss a few questions in a section that you're not so good with. Like I said, I wasn't great with health. I don't know. Here, I'm gonna create a poll here real quick. Just a second. Oh, actually, there already is one. I'm gonna launch it. And if you can, take the poll and let me know what tests you're taking, so I can kind of focus my um, on. So far it looks like it's pretty balanced between life only and life and health. One thing that I'll say about life and health, the beginning of the health content, there's a lot of crossover between life and health. And then also, if I just stay in life the entire time, a lot of the back end content on life applies to both life and health. The contract stuff, um, definitely the exclusions, uh, the add-ons or the riders, they all very much apply to both. So, um, so yeah, it's about 50-50 here. So, but again, there's a lot of crossover between basic terminology and basic concepts of life that go to health and vice versa. So there's a benefit to being in all of this. I always tell people, if we transition over to health, you can drop out if you want to, but there is value in getting it. Unless you're a person that only has limited amount of space in your brain, and you don't want to muck it up with any extra. I can understand that as well. So, because I'm one of those people that only has limited amount of space in my brain. So we're going to go ahead and get started into um, our life insurance comprehensive review. It says comprehensive, but really what we're doing here is fundamentals and basics, because I have people represented from different states in this group. So I do general concepts in here. I do not do state specific stuff. So if you're just joining us, please drop your email address in either the chat or the Q&A, and I will send you study materials out after the fact. But and again, if you're just joining us, my name's Matt. I am the guy that runs the webinars, and I'm your study buddy. I'm here to help you study. So we're getting a lot of people in here. So I will not be giving you the opportunity to unmute, but you can always throw questions in the Q&A, and you can throw questions in the chat. Good morning. I think you've been in here before, bud. Rockabon. So you're going to be really prepared because you're hearing a lot of the same stuff over and over again. Well, my last one, I did a 6-hour this week, and we made it all the way through the life content, and that never happens. So, but we will in this one, because it's 8 hours, we'll go through life, and then we will switch over to health. But again, like I said, there's a lot of crossover between both, so it's valuable to stay in all of it. So because a lot of these terms, they apply to both. So all right, cool. So it looks like we're kind of hovering around the same amount right now. So I'll go ahead and get into the content. I will monitor the Q&A and the chat. But life insurance fundamentals, definitions. One thing you probably should know if you're taking your life insurance test is what life insurance is. A contract that provides financial protection to beneficiaries upon the death of the insured person. So, it's a contract or a policy that provides a benefit when the insured passes away. And then as we're going through these terms, one good thing that will help you learn the content is stringing these terms together because they're all connected. So we've talked about the insured person. It's in this first definition right here. The insured. So the first term right here is insured. The person whose life is covered on the policy. Well, you might say, well, that's the policy holder, right? Nope, not necessarily, because people can have insurance on other people. So insurance provides financial protection. One thing, that to understand is that life insurance creates an estate for people, and that is that's a question. Now it'll be later on in the content, but I like to bring it up right away so that you have a greater understanding of what life insurance is. So because a large amount of money will be paid out to the beneficiaries, it creates an estate. Again, not everybody's really good savers. Not everybody, most people live paycheck to paycheck. They're just living to pay their bills, and that's about it. They're not leaving an estate to their children. They're not leaving a big bunch of money or a bunch of assets to their children. So life insurance is a way to create an estate in the event of your death. And that's the death benefit. So the amount of money that a policy pays upon the death of the insured is the wealth or the death benefit when the insured dies. So you're tying these two things together, insured, and then that death benefit is paid to the beneficiary, and the beneficiary is the person who receives the death benefit. So you have a life insurance policy. Let's just use $100,000. When the insured dies, the beneficiary, the person that the insured or the policy owner, this guy over here, names as the person to receive the proceeds of the life insurance when the insured dies. You see, we've strung all these things together now in one. You have the policy owner. Policy owner chooses the beneficiary. No, no, the policy owner can be also the insured. In fact, that's most times how it is. The policy owner is the insured. But in the case of um, let's say a parent has a life policy on their child, the policy owner is the parent, and then the insured is the child. And there's all kinds of different scenarios. There's insurance where a business owner has insurance on an employee or the CEO of his company or things like that. There's all kinds of different things where the policy owner is different. And then, so yeah, and we'll get into a lot more of that, those details further into the content. So, and then you have the premium. Again, self-explanatory is the amount of money that you pay to keep your policy in force. Um, I was talking one-on-one with Charlie earlier, but there's certain things, there's certain questions and answers that are just going to be simple. The worst thing you can do is sit and overthink, like think that, oh, they're trying to trick me or whatever. You know, if it's simple and you know it and you understand it, go with the simple answer, honestly. Because I think a lot of times with the professional licensing, the most tricky that they will get is they will ask a question in a way of, they'll say something about name what doesn't apply, so it'll be something to the nature of, what about term life policy doesn't apply? And the answer will be builds cash value. So instead of being a positive answer, it's an answer in the negative. What doesn't apply? That's probably about the most tricky that they'll get. Okay. Guy asked the question, why a parent insures their child? I thought the purpose is to recover lost income unless the child supports them. Well, the funeral is one reason, because the average cost of a funeral in our country is $10,000. And then also, if you lose a child as a parent, maybe you want to take some time off from work to grieve the loss of your child. There's a lot of different reasons to have, um, insurance on a child. But I think the main thing would be just burial costs, the funeral, and then, maybe time off. It's not to create wealth. Obviously, you're not using insurance on your child to create wealth or recover lost income, but it's definitely a change in dynamic to a family. I mean, children create tax benefits. Yeah. So it's a good question, though. I've never been asked that question, but that's a great question. So, but like, if you drive a car, you're familiar with a premium on an insurance policy. So, that's again, that's going to be easy. And then cash value is a savings component in permanent life insurance, or what's also known as whole life. And we'll get into that in the next couple slides. We'll learn about whole life. So all these things, you saw how we strung all of those terms together, and that will help you learn the content. And I say pretty much all the same stuff in all of these things, but the one thing that I like about life insurance as opposed to health insurance is life insurance has a lot of conceptual value. Learning the reasons behind things is important to learning the answers. But health is kind of different. It's basically you're just kind of learning facts and dates and things like that. But with life is different. I can, help you, kind of learn the why behind the what, and then I'll help you get to the right answer. So, types of Angel says parents insuring kids to have life insurance as they become adults and allow them to change the beneficiaries so their grandchildren are taken care of. They can be transferred to the adult child. Yes, yes, absolutely. That's another thing that I did not think of is that kids can have those policies as they grow up. So then they start out life as an adult with life insurance. So, and that's a very good point, because when you get older, qualifying for life insurance becomes more difficult. Yeah, you'll get a copy of this recording. Now, I won't, when I email you out the study contents, I won't send you a copy of the recording because it won't be available yet, but it gets posted to dashboards within about a day or two. But yeah, Angel brings up a great point about child insurance, because again, as you get older, it gets harder and harder to qualify for insurance, and especially good insurance. And there's more about that topic further into the content, so we'll see a little bit more, but that's a great point. Another reason is so as children become adults, they'll have already established life insurance policies. I have a life insurance policy that my mom took out on me in 1975. So I still have that policy. It's actually a whole life policy. It has cash value on top of the death benefit, which we're going to talk about right now. And I'm very thankful that she did that. My great grandfather was an insurance agent for Western and Southern Insurance. So I have insurance in my blood, and it was always important for my mom. And I'll talk about her quite a bit because she passed away 2 years ago, and really is the reason that I'm here doing this right now. So traditional whole life products. Number one is ordinary whole life. This is your basic ordinary whole life, permanent life insurance with level premiums. So what does it mean permanent? Meaning not term. Term life insurance only is good for a certain period of time. Or whole life is permanent. And by permanent, it actually means to 100 years old. So if you make it to 100 years old, you're done. Your life insurance will automatically pay out. You won the prize. So, but that's what permanent means. But there is an expiration date, but it's 100 years old. And again, most 99.9% of people don't make it to that. And the other thing about whole life policies, they build cash value over time. So part of the premium that you pay on a whole life goes to pay for the death benefit, and part of it goes to towards like a savings account or a cash value. So and then premiums are paid throughout the insured's lifetime, and then it has a guaranteed death benefit and cash value. So again, so you say you have a $100,000 whole life policy and you pay on that for 10 years. After 10 years, you've been paying on that account and you pass away, then the death benefit includes the cash value. So let's say over that time, it built a cash value of $10,000. So when the death benefit pays out, when the life insurance policy goes to the beneficiary, the payment would be $110,000. They get the death benefit plus the cash value of the policy. So that is an ordinary whole life policy. You also have something called a limited pay. So a limited pay whole life policy, so you only have to pay premiums for a certain amount of time. So let's say you get a $100,000 whole life policy, and you have premiums that pay for 5 years. So you pay X amount of dollars. Now, it's obviously going to be more than paying those premiums over your whole life, but after the 5-year period, you have the death benefit for life. Now, the cash value no longer grows. When you have as cash value based on whatever that payment was, you have basically almost an instant cash value with limited pay. But then after that, if it's after 5 years and you only paid for 5 years, then your death benefit is good for life. So that is limited pay. Now, again, there's not a whole lot of, this is easy stuff, right? That, the way that question would be asked is, how do limited pay whole life policies collect premiums? A specific period. That would be the answer. And then you have single premium, meaning one large payment. So now you have ordinary, which is going to have monthly payments that are going to be more affordable, limited pay, larger for a short period of time, a shorter period of time, or single pay. So they take whatever the premiums would have been for X amount of years and you pay them all at one time. That's going to be really expensive. And then you're going to have a cash value right away that you can use, that you can withdraw, that you can take loans off of, and we'll talk more about that later as well. But both of these maintain coverage for life after premium payments cease. So these, you have that death benefit and you're not making premium payments any longer. Now these are on whole life policies, what we're talking about here. Interest or / market sensitive products. So these type of insurance, most of you that become a professional insurance salesperson will never do this. I see a raised hand. You can if you have a question, you can throw it in the Q&A or write in the chat and I'll answer it, or you might have hit that accidentally. That happens often as well. I will accidentally raise my hand often and then I talk to myself. So these are a little different because with the license that you will get as a result of this, you cannot sell these products because you have to have a special finance license in order to sell these products. Yeah, it's a Series 6 or a Series 7 type of license to sell these products because these have an investment component and they have the risk of loss. So, and so we, even though, oh no worries. I probably would have never even noticed because I don't know. I can't see that closely. So however you're in here is good. I know being on the PC, you can kind of see more and it's easier, but I know people have to be on welcome, Canada. Yeah, I'll be here. I'll be here all day. So if you're in and out, no problem. I'm the only one that's obligated to stay here. Also, if you have to, the breaks are not really for you necessarily. They're more for me. But because you guys can, you can weave in and out of here as long as you can. Currently in Canada, you're from Washington State. Cool. Or Washington, D.C. or Washington State. I'm guessing Washington State. That'd be my guess. So, okay, cool. All the way west. I actually haven't been there. I've been to California, but I haven't been to Washington. I hear it's beautiful though. So, and I'm in Ohio. For those of you that recently joined, I'm in Ohio, Southern Ohio, and yeah, green. We're green for now, but it's about to get ugly because we're definitely starting fall and the leaves are falling, and it's my favorite time of year. So I'm gonna try to figure out how to get my whole office set up out on our back deck so I can run some of these outside. I don't know how good of an idea that'll be because my dog will be attacking me and all kinds of craziness will happen, but it's something I want to do because I'm, on Saturdays I'm kind of stuck down here and it's beautiful outside. My family's all gone, but they're all gone. They're not dead. They're gone too. Our school has volleyball tournaments all day today, so I'm not there for that, which I'm okay with that because my daughter doesn't even play anymore, and so I'm watching other people's kids play volleyball, and I'm not really interested in that. So anyway, we'll get back into this. So again, you have to hold a special license for these, but you will be tested on them. So you will see these on most tests that are out there. Universal life, flexible premiums and death benefits. They earn cash value at current interest rates, and then unbundled policy components. So what these things mean. So flexible premiums and death benefits, they basically can change based on markets. So they tie these universal life policies to indexes. Basically, it could be a treasury bill, something like that, and they fluctuate. So with the fluctuation, the premiums can go up and down, and the death benefit can go up and down. So you're kind of using your life insurance as the lottery. And then unbundled basically means these are not under like a specific umbrella. You're not adding this on to another type of policy. This is its own thing. So and again, these have the risk of loss, so that's why you have to carry that extra special finance license, Series 6 or Series 7, in order to sell it. Then you have variable whole life, fixed premium. So the premium always stays the same, but the cash value will change because you invest. These are more like a 401k or like a 403b or something like that, because you can choose different investment accounts to put your cash value in. Now, not the death benefit. A lot of people get twisted up. These investments are based on the cash value. You can't invest your $100,000 death benefit, in Microsoft or whatever. Like, that'd be great if you could do that. Like, basically invest with, future money or pretend money, but that's not how it works. This is based on your cash value. So, and then the cash value obviously fluctuates with performance. It can go up or down. So again, that's why you have to hold a special license in order to sell variable. And again, when it comes from a testing standpoint, because remember, my goal here is to help you learn how to pass your test. I'm not here to help you learn how to sell insurance, although I will give you tips on that as we go through it. Small tips on on selling. Again, I've sold vacuum cleaners door to door. I've sold mortgage loans. I've sold home equity loans. I've sold all kinds of different things. Insurance. I've sold a lot of things. So I can help you in that area, but that's not my main goal. My main goal is to get you licensed. Your mentors will help you sell. Your companies will provide you scripts and products and plans and all that kind of stuff. And then, but I'm here to help you get over the first hurdle, which is passing your test. But variable universal life insurance. Now, again, this is how the question's generally asked. What type of whole life policy or interest sensitive insurance policy combines universal and variable life features? And the answer is variable universal life insurance. The answer is in the question, and the question is in the answer. So these have flexible premiums as opposed to variable whole life. They have flexible premiums just like universal do, and then they have investment control where you can use the variable component of having separate accounts. You're not just tied to one index. So, and we'll learn more about the next page. Will explain this even more in depth. So interest sensitive and indexed life. So that's what these are. These are interest sensitive products. That's why you have to have the special license. So interest sensitive whole life, traditional whole life with interest sensitive features, cash values tied to current interest rates, and they have more competitive returns. So this is talking about this. So these are whole life policies. This is just explaining what those are. Okay. So traditional whole life interest sensitive features. So they tie it to an index. They tie it to something that is tangible, a 10-year T-bill, or a, some sort of mark, maybe the Fed rate or something like that. That's what they tie it to. They tie it to something that is, it's not necessarily fixed. It can change. There's something called the LIBOR. Maybe it's tied to the LIBOR. So it's tied to something. You're going to know what that is when you choose the policy. But they have more competitive returns because if those funds do great, you're going to do great. But they can also lose money. So that's why there's an investment aspect to that. And then you have indexed life. So these are a little different. These are less risky. Sorry, I have to take regular drinks because I'm talking for a long time and my voice is shredded after a week. So index life, cash values linked to stock market index. So it could be the NASDAQ, the S&P. It's tied to that. So up or down, fluctuation, roller coaster. But these have a minimum guaranteed interest rate. Now, this is where it gets kind of interesting with index life. So with index life, they have a minimum guaranteed interest rate. So you choose this, your cash value is tied to stock market indexes, and they're going to guarantee you that you're going to get 5%. So you get the market upside, but you have a minimum threshold also. So you aren't going to go below that minimum threshold. So there's a little bit of safety net underneath that with index life. So that's a good product if you get into the point of selling these. And then again, your question might be, what type of whole life policies have cash value linked to stock market index? Well, there's your answer right there. Index life. So as you're taking your test, take the wins when they're simple and move on, and then, because again, more than likely in most cases with the testing, they're not trying to trick you. Again, like I said, the worst thing they may try to do is they give you a multiple choice and they, pick which one of these does not apply to something. You know what I mean? So that's about the most tricky that they'll get. Term life insurance. A lot of testing in this. A lot of testing terms in this, because this is your bread and butter. If you're a licensed life insurance agent, term life insurance is going to be the most amount of insurance that you're going to sell. Or I shouldn't use the word sell because you're not going to want to use that word either. Provide service that you're going to provide, the benefits that you're going to provide to someone. I gotta stop saying so. But term life. So because there's so many different, term life policies, there's so many add-ons to term life, which are called riders. We'll get into that here, and then there's all the different whole life policies. Learning about your clients is the best thing that you can do for them and the best thing that you can do for your career. So, and what I mean by that is they'll tell you what they need. If you know your product and you know the products, through you talking to them, they'll tell you what their needs are, and then they'll trust you as the professional to give them what they need. And one way that I always use as an example is in cars. One thing I personally hate shopping for is new cars. I drive an old truck. I have two of them because I found a truck that I love. So I have my main truck and I have my backup truck, and they both have kind of different features. But my truck is a basic old Chevy Silverado. It was the first truck I ever owned, not the one I'm driving now, but the first vehicle I ever drove was a Chevy Silverado. I'll tell you how old I am. It was a 1979 Chevy Silverado, first vehicle I ever drove. And for the last several years, I finally bought another Silverado, and I haven't looked back. And when I find a good deal on another Silverado, I buy it. I told my wife I'm going to go buy another one again, but we don't have any room left in our driveway. So it has the features that I need and the features that I want. And it's simplicity. It's easy to work on. The parts are cheap and plentiful. I can work on most of the stuff myself. And then anything that I can't or don't want to work on, there's no mechanic on earth that's going to look at a mid 2000s Chevy Silverado and say, "Ooh, I don't want to work on that." They're like, "Hallelujah, bring it on." So that's what was important for me. But again, a person will tell you what they need. Now, for my wife, that's a totally different animal. Her needs and wants and desires are totally different than mine. My truck does not have heated seats. Her vehicle has to have heated seats. Her vehicle has to have a third row because not only is she carrying our three kids, but she's always picking up other people's kids as well. So that extra amount of people. So, and because I've been in sales, I like recognize a good salesperson when I meet them. And that was what our salesperson selling us our car when we bought a new one from my wife. He did a great job listening to what our needs were. And when we sat down in a car to test drive it, it always had all of those features that were important to her. No muss, no fuss. He wasn't trying to shoehorn us into a car that didn't fit our needs. It was just exactly what we were looking for. So, and I recognize that and I appreciated that. And I liked using him and I refer other people over to him because he did a good job. And that's what you want to do. And one thing that I always, and I have it taped on my monitor, and I have had ever since I've been in the mortgage business, I have a little sticky note that says, "Tell me about." Now, I don't have my original one. It fell by the wayside, but I redo them when my first one deteriorated. It was 25 years old. The sticky notes, they don't last. Even though I actually have an extra piece of tape holding it on. I have the words "tell me about," dot, dot, dot. And I'll tell you the application of that. When I was in the mortgage business, it was tell me about your house, tell me about your kids, tell me about your job, tell me about your car, tell me about your dog, tell me about your garage, tell me about your yard, all these different things. And now I didn't say it that fast. I gave them time to answer and I listened and I jot down notes as they were talking, and it let me know what was important to them in their life. So that helped me put together plans to help them. And again, I'm not here to help you learn how to sell, but I think I learned the tell me about from a guy named Zig Ziglar. And one thing to help you in your career is getting ready, getting pumped up, because this is it's an emotional job. You're talking about things, first of all, that are not so fun. You're talking about death and, you know, or even healthcare. That's not, people don't want to talk about that. It's not fun. So you have to make it personal. You have to make it important. You have to make it, uh, you know, applicable to their life and really, really try to help them. And Zig Ziglar would say, if you help enough people get what they want, you'll have what you want. And, meaning if your goal in your life is just to make money and it doesn't matter what you do to people in order to make money, you might have money, but you're not going to have what you want. And that's why you see people that are wealthy and people that are rich, they're not happy because they don't really ultimately have what they want. So again, that's my little sales caveat. That's not about passing your test, but that kind of goes into the next thing that we're talking about here, which is a different type of product. And again, the main amount of product, if you're doing life insurance, that you're going to be working with, which is term life insurance. And I see some new people have joined us. I think maybe if you are new and you're just joining us, please put your email in either the chat or the Q&A. And after the live session is done, then I will send out study materials and a study video after it's over. And then I also want to hear from you. If you take your test and you pass, and even if you don't, please, let me know. A lot of times people will actually send me like a screenshot of their test results, and I get fired up from that. And you can also, tell me different things I can do, constructive criticism, that I can do that maybe you think would have helped you more than what I generally do. I'm totally fine with that. So, but right now we're talking about term. All we've gone over so far, we're only on slide 6. We've gone through general life insurance terms. We've gone through whole life, universal, and we'll actually weave back into those in later slides and get more in depth with them as well. But right now we're talking about term, and I haven't even started. So with term life insurance, again, it's the most common. So you have a payment, a term, and a death benefit. The payment is the same. It can change, but it changes on a kind of like a schedule. You'll see that as we get through here. And a death benefit, and then after a certain period of time, if you don't choose certain riders or if you don't choose a certain type of policy, it goes away. So the crazy part about term insurance is the amount of term policies that actually pay out. So meaning there's millions of these policies that are out there. How many of them actually pay out during the person's lifetime? And it's shockingly close to 0%. So it's way less than 5%. It's more like maybe 2%. So you're like, well, why does anybody have them? Well, they're generally kind of a bridge between, getting started out in life. They're a part of benefit packages with companies. Most of the insurance policies that you get through an employer are term life policies, and they're not permanent. They're term, they're temporary. So the first type is level term. Death benefit remains constant. You buy a 10-year term life insurance policy for, say, $30 a month. It's good for 10 years, and then after 10 years, it goes away. That's a level term. Basic. That's what you hear on advertising. I always say this, if you ever watch old people TV, on Sunday afternoons, watch In the Heat of the Night or old TV shows, you're going to see life insurance commercials. Mutual of Omaha, Lincoln Heritage, whatever. You're going to see these companies advertising, and you'll hear the term level term, because again, that's the most common type. Then you have what's called a decreasing term. The death benefit decreases over time. Now, why in the world would anybody ever choose a decreasing term? Well, because these are used for mortgage protection insurance. And a lot of new life insurance agents sell decreasing term or mortgage protection insurance because it's a little cheaper, a little easier sell, because again, most people have a mortgage, and it's easy to create, a sense of urgency and a sense of need for this type of insurance. Now, why does the benefit decrease? Well, because as you pay your mortgage, you get let's say a 15-year mortgage or a 20 or 30-year mortgage. as you're making payments, the balance of that mortgage goes down. So by the end of the term, on a decreasing term policy, your death benefit should be zero. When the term ends, it will be zero. And then your house, whatever, your mortgage should also be paid off, unless you refinance, which is what most people do. The average mortgage only lasts about 5 years before someone does something with it. A little longer now because rates are so horrible. Nobody's refinancing. So that's why the mortgage industry is so, not good right now. But decreasing term, often also called credit life. So I always tell an application from my standpoint is I've had multiple car loans with credit unions, and credit unions notoriously try to slip in credit life policies into their payments, and then they almost make you feel like it's required, like it's you have to do it. You don't. It's illegal to make them a requirement to get financing, but they slip them in. They're $5, maybe $10 a month. They add it onto your monthly payment, and in the event of your death, it'll pay your car off. So they get their money. Basically they're insuring your life with a credit life policy, in order to make sure they get theirs if something happens to you. So that would be a decreasing term policy. The next one is a return of premium policy. I like this product. I like it a lot because it's a way to provide two different kinds of benefits to your client. And it's almost equivalent to owning a house as opposed to renting a house. A lot of people, they talk about rent. I mean, most people rent, but they talk about rent and they're like, oh, I'm not, besides a roof over my head, I'm not really getting any benefit out of that. And it's true. So with insurance, it's kind of the same because, you pay your car insurance payment every month that allows you to keep driving. But, if you go 10 years and you pay car insurance and you never get in an accident and nothing happens, that money is lost. There's nothing. It's done nothing for you. With a return of premium term life insurance policy, let's say you have $100,000 face value death benefit on a 20-year. You can have a 20-year term. And I use this as an example. Like I said, I would talk about my mom. My mom, when she was 60 years old, she got a return of premium term life policy that was good for 20 years. It had a $50,000 face value, and the payments were like $120 a month on it. And I was like, oh, Mom, that's kind of high. But she's like, well, but when I pass away, you'll be able to pay the house off. And because I paid for my mom's house that she lived in, and so she wanted me to be basically taken care of if something happened to her. Well, what actually happened though is when she turned 80, her 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 insurance agent called and said, where do you want me to send the check? Now, she forgot about it, to be honest. She had it set up on auto pay. She didn't really think about it. She was on a fixed income. So just every single month that payment came out, $120, $120. And she always budgeted around it. So it wasn't even wasn't even a thought. And then when she turned 80, she's like, where do you want to send a check? Well, think about it. $120 a month. That's over $20,000 that she was getting back when she turned 80. Now, my mom was in pretty good health when she was 80. She was still literally mowing the grass outside with a push mower when she was 80 years old. So, she said that. And then the other great thing about it was, from the insurance agent standpoint, was He then got to turn around and sell her another policy. So he got her an end of life policy at that point, or otherwise known as a burial policy. So he got a double sale. So she got a new one. Now, here's the crazy thing about that. She got a burial policy. She could only get $7,500 when she was 80 years old. And it was the same price as the return of premium. But guess what? It didn't matter because she literally just got over $20,000 check deposited in the bank. So she had the money to pay for that premium, no problem. She probably didn't even have to, if she didn't use any of that money, it probably would have paid all the premiums for the rest of her life because she only lived 8 more years. She passed away when she was 88 years old. She had one whole life policy and one term life policy, and it didn't make me rich. It covered her funeral, and then when it was all said and done, I got $800 back. So, yeah, nobody's getting rich off that situation. But she got a return of premium policy, which was a great policy, and we'll talk about that again when we get into riders. So, another term life policy, and always remember what we're talking about. It's going to help you when you're studying. Is an annually renewable term. We go from a product that I love to a product that I hate. Premiums increase yearly, but they are renewable without a medical exam. When you get life insurance, you don't always have to get a medical exam, but there are always health questions involved, and they determine eligibility and cost of an insurance policy. So with an annually renewable term, the premiums will increase every year. Now, they might start out insanely cheap. So you might get a term policy if you qualify for it medically, maybe $5 a month for, I don't know, $50,000, $5 a month. But then a year from now, it renews automatically. But then your $5 a month premium is now $10 a month. Same coverage, but it renewed. And you didn't have to get a medical exam. You did not have to prove eligibility. So again, why would anybody want one of these? Well, maybe you're just graduated from college, you're starting out a job, you're in the mail room, but eventually you're going to be, a paralegal, or you're going to be something else further up in the company, so you're going to make more money every year. Well, you get a annually renewable term. Your income is more a year from now than it is today, and you don't have to worry about whether you're going to be eligible for that policy. So, and from a testing standpoint, this is pretty self-explanatory. Annually renewable, premiums increase yearly, and then it's renewable without a medical exam. That's how it would be. The questions and answers would be asked on the test. So, special features, term life special features. So these are on a specific type of policy. Now, we just talked about annually renewable term. There's also something called a general renewable term policy. Well, the difference between annual, and again, take the easy wins. Annually means yearly. So the way that these questions are going to be asked, it's going to be pretty self-explanatory. And then again, with renewable, the most important thing to remember is it renews without a medical exam. But with term life special feature, these are policies that contain special features. The way that I kind of explain these is, if you buy a specialty pizza at a pizza joint, and basically, they already come with certain toppings. You get a Hawaiian, it's got ham, onion, pineapple, and whatever on a Hawaiian. Or meat lovers, it has every meat that they have. Well, these are term life policies that already include special features. Now, you can also get insurance policies a la carte. So you can get riders or add-ons, and we'll talk about those in general. Sorry, I'm texting my wife. So, but these already include it, but you can do add-ons, and we'll talk about that in detail. I do take breaks. I will go ahead and go until noon, and we'll take a short break at noon. And then because we kind of got a late start, I will do our long break, which will be like 1 hour, and we'll do that at 1:30. We'll do a 1 hour break, and then after we come back from that break, we will transition into health. But again, the first part of health will be applicable to both health and life. So there's a benefit to staying for it. But if you absolutely have to duck out, it's totally fine. But we'll stay into health or life until 2:30, and then we'll go from 2:30 to 5:30, and then we'll be done for the day. So again, these are special feature term life policies. Looks like we gained some more here. Yeah, so if you're new, this is a study session for we're in life right now, and drop your email in either the chat or the Q&A, and then after this is over, I will send you out some study materials. So if you're just joining us, and again, my name is Matt, and actually my name is support team right now, but I can change that. I forgot to do that. Rename myself. See, I already did this, but I did it in our other one, and I forgot to do that. That's me. So you know who you're dealing with now. And I do quality control for the website, and I do pretty much 100% of these webinars now. And we do these on Saturdays, Tuesdays, and Thursdays. And we're adding new ones all the time. And we're going to be adding one-on-one sessions that you can purchase, and you can do some one-on-one sessions. That's you guys will probably all be licensed before that happens, because that's just in the works now. So and anyway, we're talking about term life policies right now, and these are term life policies that have special features built into them. So you have a renewable term life policy. And so as opposed to annually renewable that renew every year, they're similar. They renew at a different like interval. So these might be renewable after 5 years or after 10 years. And then you can renew them, and then you don't have to get a medical exam at that time. To me, these would make a little bit more sense. They're probably a little bit more expensive than an annually renewable, but to me, these make a lot more sense than the annually renewable. But the premium still will also increase, and I'm going to guess they're going to increase a lot more than they would on an annual. And then renewable says usually to age 65 or 70. What does that mean? Meaning that's where they're cut off. So you can't get a renewable term life policy when you're 65. You probably can't get one when you're 70. It really just depends on what the policy is. It depends on what your state laws are. But the way this question would be phrased, because again, remember, my goal is to help you pass your test. It'll say, what are the cutoff ages for renewable term life insurance policies? And the answer would be 65 or 70. That's how that question would be phrased. And then also know that in renewable, that you don't have to get a medical exam when you get a renewable type insurance policy. Then you have convertible. So another one that I love is convertible. So you start out with a term life policy. So say 5 or 10 years. And then at the end, you can turn that term life policy into a whole life policy. And with no evidence of insurability, no medical, anything, you just automatically convert it. Now, it's probably going to be a shock to your pocketbook. I mean, I'm not saying probably, definitely, because if you have a 10-year, $100,000 term life policy, and you, after 10 years, you convert it to a $100,000 whole life policy, that premium might go from $20 a month to $100 a month. Now, is it worth it? Absolutely, it's worth it. But again, after 10 years, hopefully your state in life is better. You've had promotions at work, you're the manager at work, maybe you're an entrepreneur, you got your own business and business is going well, you're finally making money, and you're able to do the whole life policy. You can change your term life to a whole life policy. So that's a convertible type term life. But you have to agree to that again at the beginning. That's the type of policy that you're getting, a convertible term life policy. So that's the combination there. And then again, the conversion period, typically 5 to 10 years. You can get a 5-year term and convert it to a whole life policy, and a 10-year term. They don't go much beyond 10-year terms because, honestly, 10-year term is your bread and butter anyway. 20 years you can get on maybe like a return of premium type term life policy, but the basic term life policies are 5 and 10 years. So that's why they make these convertible ones 5 or 10 years, because they want, they want you to have whole life. They want you to change. they want to make more money on you. It's from a sales standpoint, I always called that the two-step. It's a two-step process in order to you making money. This is on your side. And doing the convertibles or the renewables, things that allow you, or the return of premium, things that allow you to sell multiple policies to the same client, and it actually be a benefit to them. You're not doing it just so you can make more money, but you're doing it because it really is truly the right product for the customer, for the client. So, and that's how you get referrals. That's how you get repeat clients, is by doing things that benefit the client. So, all right. So you got single, we're transitioning. And again, we'll weave in and out here. We're going into annuities. So I'll do this page of annuities, and then we'll take a 15-minute break. Annuities are different than life insurance. So life insurance is death benefit, creating an estate after your death. Annuities is managing an estate during your life. Now, there can also be death benefits to annuities. So, and you'll see that as we get deeper into the content. But the best way that I can explain like what an annuity is, so that it's understandable for you, is it's a managed wealth account. So let's say, in most basic terms that everybody can understand, is that you win the lottery. And the first thing you do when you win the lottery is choose how you want to get your payment, either by one lump sum or payments over time. So some of the recent lotteries have been absolutely huge. Like it was over $1 billion for the first time ever. That's where we're at in cost of living in our world, that the lottery gets over $1 billion. And so you win the $1 billion, and you say, well, either I'm going to get, I'll just throw a term out, $20 million a year for the rest of my life, or I take one lump sum. And I think that when it was over $1 billion, the lump sum was like 400 and some million dollars. And then After taxes, it was 300 and some million dollars after you pay taxes. So the net was like 300 and some million. You started a billion and you ended up 300 million. So, but the payments over time is paid out of an annuity. So the lottery has a big annuity and they have multiple winners that they're paying out of that annuity annual payments. That's how it works on a lottery. Now there are some, you know, I've seen scratch off tickets that say, win $5,000 a week for life or something like that. Again, same thing. It's an annuity. It's funded out of an annuity. So an annuity could be funded by payments over time. You're funding it like a retirement account. It could be you got a settlement from a lawsuit or something like that, or a family member, long lost family member dies, leaves you a chunk of money. You set up an annuity. Now, even the people that take the lump sum on a lottery win or something like that, the first thing that they should do is set up an annuity, meaning they put that money somewhere where it's going to grow and then they can start drawing payments out of that annuity. Because if not, they're going to blow through that money so fast. And there's whole TV shows on, like what happened to my lottery money, because people will win big lotteries and then a short period of time, 2-3 years, sometimes they're broke again and they're totally broke. And you think, well, how in the world that happened? Well, they didn't do anything right, and then you had, they had family members come out of the woodwork. Maybe they bought houses for all their family members and cars and then started paying those people's bills. And, people will use you up if you give them an opportunity. They will use you up. So Angel says, like a trust, but with more returns. Yeah. Well, and a lot of, oh, I see another note. It was kind of hidden. Thanks for sharing these study sessions. Much appreciated, Michael. You're absolutely. I appreciate you for coming in here. And then Angel says, like a trust, but with more returns. Well, trusts are a lot of times part of these. Like they go with them. So the money will be like in a trust, and then the trust will be the beneficiary, of the death benefit, or the annuities will pay into a trust. That's more of a a shelter or a protective shelter for money. So and it clearly defines who gets what when. Oftentimes you see a situation with a trust where a child is a beneficiary of an estate and they're not 18 yet, so they can't own, they can't manage a big chunk of money on their own. So they have a trust that names a, say a guardian over the person, and then it tells that person how they are forced to manage the money. Very good thing to have, especially when you're dealing with big estates. I don't know if anybody in here has ever been to Hershey, Pennsylvania, but Hershey, Pennsylvania is a fascinating place. And I went, and we went to Gettysburg, and then we went to Hershey after. And I was kind of like very flip about it. Was a longer trip, and Hershey was kind of the end of the trip. And we had just gotten back from Scotland like 2 or 3 months before that. I am not a traveler. I'm really not a world traveler, but for some reason, for a short period of time, we had a lot of travel on our calendar. And by the time I got to Hershey, Pennsylvania, I was like, I do not want to be gone anymore. I just want to be home. I was just done. And so we didn't go to the amusement park, but we went to like Hershey World or whatever it's called. And that there was you could do all kinds of crazy things, make your own candy bar, huge you would think I would be super excited about being in a giant candy store, and there was a part of me that was, but I was just done with that trip. And I say all that to say this: um, we went on a trolley tour, and I was like, yeah, cool. I'm going to ride a trolley through Hershey, Pennsylvania, which really doesn't look like that exciting of a place. Um, and then listen to some dude talk about the history of the Hershey company. Well, it was way more than that. And honestly, and it was like $15 a person. I was like, man, that just seems expensive. I'm here to tell you it's the best $15 I ever spent. That was the most fascinating thing. And of course, the host was really excited. Like you would be so much more excited having him as your teacher today, because he was just engaging and you know positive, full of life. He was just a really cool guy, and we learned about the history of Hershey and how he built his company. And I won't go into all the details, but if you have an opportunity to study on it, it's very interesting. Or if you have an opportunity to go to Hershey, definitely go take the trolley tour. It's amazing. But you see the legacy that Milton Hershey left behind, a man that never had kids of his own, has provided education and a life for thousands of kids. The guy that was that led our trolley tour, he was a graduate of the Hershey School. There's a school and there's a program where they take at-risk kids every year, a certain amount. They move them out to Hershey. They put them in a family. All of their expenses are taken care of. They go to a school that I tell you has the amenities of Harvard. I mean, it is a beautiful school. You see all that, and I think they have 4,000 students right now. And again, all these students live on this campus. They're high risk, at risk kids. They maybe were homeless or in foster care, and someone nominates them to go there. And he was a graduate of the program. Now he was an older gentleman, so he had to have been, he probably graduated the program in the 60s. But and then he worked as a, I don't know, some sort of manufacturing job for 30 years and retired, and he did the trolley tours in his retirement. And but all of that is still funded by the money that Milton Hershey made while he was alive in the 1930s and 1940s. And the money is in a giant annuity, and um, they live, they fund all of it off the interest. So, and it's so fascinating because they have these communities with all these houses, and these are big, nice houses. And then they hire parents to live in those houses, and they'll manage about 8 kids per house. These, again, high risk, at risk kids. And then for good behavior, they will pay college fully for the kids if they live in the house, go to school, get good grades. They get a fund built up that when they graduate from high school, they have a full ride to, I don't know if it's any college, but to college, after they graduate the program. And they have a family. They have siblings. They have a family. They have a mom and dad, and they live in just this amazing place with all these crazy amenities. So again, when you're taking at-risk kids and you're putting them together, you think maybe you're going to have a really bad time, and I'm sure they have some rough situations, but you couldn't tell from a aerial view where you're looking at it. This looks amazing. But the main thing is they were paying for all of it just off the interest of the money that Milton Hershey made in the 30s and 40s, which was the equivalent of like $2 billion or some crazy number. It was like 380 million, and they haven't touched the the base amount of the money in, I think he said 20 years or some crazy number. I mean, it's insane. It's really, really cool story, fascinating. I would highly recommend. I can't believe I'm recommending going there and doing it, but I am. And then also, if you like chocolate, you literally get free chocolate on the trolley ride, which I mean, you're not going to complain about that. So, but for me, it's time for take a break, and I didn't get very far into annuities, which is fine because we do a lot on annuities, and then we'll weave back into insurance, and then after our longer break, we'll transition over into health. But I will turn my camera and my audio off during the breaks. It's about 12. We'll just do, because I've kind of had an extended period of time this morning. I'm gonna come back at 12:20, and then we'll do our longer break at 1:30. But we're going to take a quick break. If you just showed up, I'm sorry that we're taking a break right away, but it's kind of how it goes. So, and I'll put a sign up that you'll be able to see on the screen that we're in a break. There you go. We're on a break. So again, we'll come back around 12:20. That way I can go use the restroom, refill my drink, and then take a few minutes to take a deep breath, and then I'll come back and we'll get into annuities. So appreciate you being here. Hopefully all of you are here when we get back from the break. So thank you so much. See you in a little bit. Man, looks like everybody hung with me mostly. That's good. That rarely ever happens. So I appreciate it. Thanks for hanging with me, especially on a Saturday, giving up your Saturday. If you're a college football fan, you're missing all that. But yeah, that just shows you have an extra level of dedication to passing your test, and that's what you need. And that very impressive. Either that or you're in Illinois and you're forced to do this. So either way, kudos to you. And so we were in annuities, and we will take a longer break at 1:30, like about an hour. And then when we come back from that, we will transition into health for the rest of the day. But like I said before, health, there's a lot of crossover between health and life, especially in the beginning of health. So there's definitely a benefit to staying in for that. Hold on just 1 second. Some airflow down here. So we do not have the air conditioning running right now because it's cooler outside, but that doesn't always translate to the basement. So I had to get the fan aimed at me. So I'm like sweating. But of course, that on my break, I went out and we raised chickens. So I went out and opened our chickens. So because also when I'm sitting for a long time, I need to get out and take a walk. And so I went out and opened our chickens for the day. So that's what I did. That's why I'm sweating a little bit, but it's also really stuffy down here as well. So I'm in the basement and in my lair talking about annuities. So, and we didn't really cover any of this yet. So we just kind of did a basic overview of what an annuity is. So we're going to learn how they work. So, and keep in mind, with annuities, with your life insurance license, you're licensed to sell annuities. So you don't have to have a special license unless, again, you're selling the fixed or variable type of annuities. So anything that has the risk of loss, then you do have to have your extra financial license, a Series 6 or a Series 7. But so annuities provide an income based off either a lump sum of money or a lump sum of money that grows over time. So you have a single premium annuity. So again, how does that happen? That happens if you inherit a bunch of money from a family member, or you win a lottery, or you get a settlement from an accident or a lawsuit. So then in order to make sure that money is secure, instead of just throwing it in the bank, you throw it into an annuity. An annuity is like a savings account. It's going to grow. Regardless, it will have some sort of a growth, but some is just more like a certificate of deposit where it grows at a certain level. So there's no risk of loss for those. But so you can use your regular license to sell those because there'll be a certain growth rate. But again, so a way to kind of understand this a little better and understand the product, whenever, just like with a savings account or money that you have in a bank, the bank takes that money and they invest. So your money just doesn't sit in the bank. Now they have money sitting there, but I don't know if you've ever watched the movie It's a Wonderful Life, and they call it something called a run on a bank, where everyone comes out at one point in time, they freak out and they try to take all their money out of the bank. Well, there's probably not enough money in a bank for most banks to pay all the money that they have represented in their account. So that because they invest it. Now with an annuity company or with an annuity, if it has a set interest rate that it pays out, like a certificate deposit, a CD, and they do better with your money than what the CD's paying out, they pay the guaranteed rate and that's it. And then they pocket the rest. But again, it's a way to secure your money. You're going to get a better rate on it than a just a savings account at your bank. Those are usually a fraction of a percent. And then also it's giving you some sort of guaranteed income. Now they have paybacks that are different than monthly, and then we'll cover those also. We should get to them. So you have a single one lump payment, flexible, multiple payments over time. And then payments can come to you either immediately, and what they mean by immediately is either one day or 1 week up to 1 year. So, it could be a payment that starts in 11 months, but they consider that an immediate. And then deferred, and then that would more apply to a single payment annuity, meaning one big lump sum was dropped in there and you're immediately starting to draw an income off of that money. So, again, in the case of possibly a lottery or some sort of a settlement or something like that. And then the payments begin immediately, meaning within 1 year. And that's the way the question will be on the test. So an immediate annuity payment is payments that begin within 1 year. So, and again, like I said, they could throw a twist and they could say, an immediate, name all that apply in regards to an immediate payout on an annuity. And then maybe the answer, or pick what doesn't apply to an immediate annuity. And maybe the answer in the multiple choice is payments that begin within 2 years. But well, we know it's not that. They begin within a year for it to be an immediate. So the answer to that question, because they're looking for what doesn't apply, is payments that begin within 2 years. And then deferred would be more on a flexible payment where you're funding an annuity over time. Maybe you have X amount of dollars come out of your paycheck, or if you're a business owner, you pay X amount of dollars into an annuity every single month for your retirement. And then the payments are deferred and they start at a specific date, maybe when you're 60 or something like that. So you have fixed and variable. Fixed are what I talked about. It's a guaranteed rate. Again, as a licensed insurance agent, you can sell something that has a fixed rate, meaning it grows at that rate regardless. But again, there's no extra investment on that. So if the insurance company does better with your money, they've already agreed to pay you on a fixed schedule, that you're getting that's what you're getting. They may do better, but that's how life insurance companies stay in business, because and they have big buildings and their CEOs make a lot of money. So insurance companies are not hurting. I wouldn't feel sorry for them. That's how they weather the storm, literally and figuratively, whenever big things happen. COVID, natural disasters, hurricanes, tornadoes, whatever. insurance companies stay in business because they're still making a lot of money. And we want them to, because we want them to be there for us when we need them. And then you have variable investment-based return annuities, and then those you have to have a special license in order to sell those type of products. So annuity periods and payouts. One thing to know, there's two types of stages to an annuity. The accumulation period, the period when the account grows, or the accumulation or the buildup or the pay-in period, it's also known as. And then you have a payout period when the annuity starts paying income. So the payout period is also known as the annuity period. And I've seen it asked that way on a test, is the accumulation period and the annuity period. So, and the accumulation period is not known as the annuity period. It is for an annuity, but the payout period is the annuity period. So that's what you would see on a test. It could say payout period when income is received, but likely on the test it's going to say the annuity period. And then you have payout options on an annuity. Okay, so this is how the money is coming back to the annuity holder. You have life only. Probably the most amount that you're going to get. And then also probably for a single person that has no family members or no family members they like enough to give money to after they die, or again, they're older and they don't have any kids or a spouse or anything like that. So they get a high amount of income to live, make their yacht payments. And then when they die, it's gone. That money's gone. If there's money left in the annuity, the annuity company keeps it. It just goes to them. It doesn't go to the state. There's no beneficiaries. It's just gone. So you imagine the annuity companies love these because, but I personally, if I was that person, I'd be watching my back. If Allstate's managing my annuity and I see an Allstate car driving around me, I might be looking over my back like, oh no, they've sent out a hit out on me because they want the money that's left in my annuity account. No, that's not. It's just a joke. It's not really happening, but that's the way my mind thinks. Is that everybody's out to get me. So that's life only annuity. Payments for life only, no beneficiaries. And then life with period certain. Okay, so these would have beneficiaries. So let's say, all right, I want to basically get, I'm funding the annuity with $1 million and I want it to pay me back for 20 years. And they say you're older, you're like 70 or whatever. You don't think you're going to live that long. You're not in great health, but you want your spouse or possibly your kids to have income beyond after you pass away, something to get them through, maybe to pay for their college or what have you. Life with period certain. So meaning 10 years or a 20-year period, and you pass away after 10, and then your beneficiaries or your family, they draw that same amount of income for the next 10 years. So period certain. Now, this is an application that I used when I was in the mortgage business, because we would have to basically guarantee income for a client in order to qualify for a loan. And in order for assets to be considered income, they had to last for 36 months. So we would, this would be in a case of, a lot of times this was older folks buying a second home or a vacation home or a second home. And they were trying to qualify for it, but they had just recently retired, so their income dropped quite a bit, but they had all this money in an annuity they were going to live on. Their primary residence was paid off, but they just wanted to buy this vacation home or whatever, but they needed the extra income. So we would have them set up their annuity on a life with period certain basis. So that would show that their income was guaranteed for 36 months. And let's say it was, $5,000 a month for 36 months. And then that's the money that we used to qualify them in order to lend them money on their vacation home. So that was the application of a life with period certain annuity. And then you have joint and survivor. So this is a joint annuity. This is a husband and a wife, or, it doesn't always have to be husband and wife, but it's just the easiest example to use. Spouses in general. It could be, single dad and older child that lives in the house. Doesn't matter. Two people that have some sort of a commonality. And then that annuity has X amount of dollars in it. And when one of the people die, that's part of the annuity, the payments automatically continue over to the survivor. So this is different than like life insurance that names a beneficiary, because there's no question who the person is going to, there's no break. There's no, all right, well, we've got to figure out who the executor is or anything like that. You're on the account. So there's going to be no break. It's going to automatically, the payments are going to continue to the survivor on the joint annuity. And then the other things would apply. If it's period certain, then it would go for the period that's guaranteed, or if it's life only, it would go to the life of the survivor only. So then once the survivor passes away, then that money is gone and there's no beneficiary. But if it's something like the next thing, which is an installment or a cash refund, that guarantees the return of the purchase price. Meaning, if you fund an annuity with $1 million, they guarantee that $1 million will come back to either you as the annuity holder or your beneficiary. So let's say you fund an annuity with $1 million, and then you live for X amount of years, and you pay it. You get paid $500,000, and the balance is roughly $500,000 still. When you pass away, the beneficiary of the account will have the rest of the $500,000. Or it can be a cash refund or installment type annuity on a joint survivor account. So then whatever's left in the account would go to the survivor, and then when that person dies, it goes to the beneficiary. The main thing about an installment annuity is however much goes into it is going to go to somebody. You're going to get all of that money back. Now, there still may be extra money there that the insurance company makes off of you. Obviously, they're making money off of you somehow, that will not go to the beneficiary or will not go to the survivor, because that's over and above the purchase price. That's over and above what you use to initially fund the annuity. So these are the terms. This is the info. Learn the terms in the info. So, and that's again what I'm here for, to give it to you in another way. Going back to that original question about tips that I have for like studying, everybody learns differently. This is just another way for you to consume the content, to hear it, and then also have it explained to you a little bit better, a little bit more in depth. But I suggest writing things down, listening to it, listening to, watching the study videos, um, rewatching them, especially if it's in an area that you're weaker on. Watch them, rewatch them, and then practice tests. For me, practice tests is where it's at. That's where I learn the most. If I have a general grasp of the content, practice tests is what drives it into my subconscious. And that's how I learn the content. But again, use all the tools, use them all. And then again, once this is over, you just joined us, throw your email in the webinar chat or the Q&A. If you've already done it, you don't have to keep doing it. I'll scroll back all the way through after this is over, and then I'll show you what I do. I have I put all the email addresses on a screen, and then I copy, and then I paste them into my email, and then I send an email with PDFs and a link to Justin's video that he produced about creating your own study materials. So all right, we covered all that. So combination plans. All right. So we are talking about, this is going back into life insurance here. So, and honestly, this could also apply to annuities. This doesn't really apply to health insurance. This is life insurance specific right here. But you have combination plans. These to me are always a little bit funny, I guess. Not funny, but weird the way they're worded, and it's exactly how it will show up on a test. But so you have something called joint life. Now we looked at joint annuities, and these work. So there's kind of a crossover here. It covers multiple lives on the same insurance policy. So as opposed to having separate life policies, maybe instead of a husband and a wife each having a $50,000 life policy, they have a $100,000 life policy on both of them. And it's what's known as a first to die. And so that is literally the term that they're going to use. Sorry, I kind of that didn't work really good. Hold on. I did a bad job circling. But first to die. So meaning you have a joint life. It covers both lives. And then whenever out of the joint account, the first one to die, the proceeds or the death benefit pays upon the first death. So multiple lives under one policy, one of the members of the joint dies, then the one that's alive gets the money. And again, that's different than a beneficiary, because a beneficiary there's still a question about who they are. Everyone has to confirm that there's no one else in line for that money. So it's not immediate. With a joint policy, it's immediate, and it's a lower cost than separate policy. So that's why people do it. You get more bang for your buck, more death benefit covering multiple lives. Now, always keep in mind also, though, both members have to be eligible. They have to medically qualify. Now, again, depending on the policy, there are loosier goosier life insurance policies. You'll see advertisements, no medical exam required, or you have more of an end of life type. And honestly, it seems like the threshold anymore is like 50,000. You can get a $50,000 life insurance policy. even if you're not in perfect health, they'll say, oh, you can have diabetes or hypertension or whatever. And all they'll do to verify that is use your application. And then if they have any questions about what you put on your application, they'll do a Mortgage Information Bureau report, or called an MIB, and then they'll verify the public information. It's not public really, but you sign a waiver. They'll verify that information. And, all of our health records are digitized now, usually like my chart and whatnot. So they order those reports and find out generally what kind of health you're in order to write those policies. But in a joint life, both people have to qualify. And then survivorship, or second to die, this kind of just, to me, I don't know why I find it funny. It's just very on the nose. First to die, second to die, survivorship life. And then this pays after both insureds die. So this is used for estate planning. Meaning what? Meaning this is going to go to a beneficiary. This is going to create an estate. So oftentimes these are used in a situation where there's a lot of marital assets. So that's what it means by this. It takes advantage of unlimited marital deduction. What does that mean? So you have a survivorship life or a second to die policy, pays after both people on the policy pass away. So it's not a burial policy, because if the husband passes away, you have to have a separate policy to cover the burial. If you have a survivorship life, that can't be your only insurance policy. If the other spouse dies, they don't get the money to pay for your burial. They have to have a separate policy to pay for that. This is an estate for your dependents or your beneficiaries. And what the unlimited marital deduction means is, let's say, again, you have a situation where, you have a lot of physical assets, but not a lot of liquid assets, homes, cars, boats, jet skis, second homes, whatever. There's tons of assets. Maybe they're not all paid off. There's a lot of estate debt. If there's no estate debt means nothing. That's another question a lot of people have. People die and they have a lot of debt, let's say you're the executor. So in my standpoint, my mom passed away when she was 88. After it was all said and done, after her funeral was paid for, it was $800 left. That was it. She owed quite a bit of money. My mom was pretty reckless. And I had people, they had my number and they would call me and I would be like, there's no estate. There's no money left. She didn't own anything. There was nothing in her name. I bought the house that she lived in 2004. She died in 2023. So she didn't have any assets. She didn't own a car. She never drove. So when they would call, they'd be like, yeah, you ever heard the term, you can't get blood out of a turnip? Well, congratulations, you just found your turnip. There's no money for you. But in this situation, it's different. There's tons of assets, there's debt, there's all kinds of stuff. So they leave a survivorship life policy, and the beneficiaries, the people that inherit this money, can use it to pay off the estate debt, to pay off the homes, to pay off the cars, to pay everything off, so that the people that are in the will, or the people that are left this money, don't have to sell houses, sell cars, sell things in order to pay for those, because then you end up in a situation where you're paying capital gains tax, or you might be paying capital gains tax. So that's what a survivorship life policy is used for, estate planning, and it pays after both insurers die. This is how it's going to be tested on. And then the marital deduction thing, may or may not come up, probably not, but it's good to know. It's good to understand. So Gotta do these in one swipe so I don't have so much to erase. Those are combination plans. All right, our first quiz. And with the amount of people in here, I'll just go through the quiz. Sometimes if I only have a few, I will, let you guys throw answers into the comments, but there's just too many. It gets chaotic. So I'll go through it. That way you can just kind of see how the questions are structured. So first question is, which type of whole life insurance policy requires premiums throughout the insured's lifetime? And we know, based on what we've already studied, that was in the beginning. So if you came here late, that was called ordinary whole life. I usually get hundreds on these because I've taken them so many times. When I get further into the content, it gets a little more murky because I haven't taken those as much. I don't always get that far into the content. Key feature of universal life insurance. Universal is flexible premiums and death benefits. When I think of the term universal, it's more, open. It's more, loosey goosey. A lot of tools it's a universal bit or something like that. And it means it's a bit that works on more than one thing. So universal life insurance, flexible premiums and death benefits, they change. Variable universal life confines features of which two types? Well, it's variable and universal life. Don't overthink it. Universal and variable life. The only thing they did is change the order. Which term life feature allows renewal without medical exam? That is renewable. The answer is in the question, and the question is in the answer. Now, convertible does also, but that's not what it's asking here. This is talking about renewing term life, not converting it, renewing it. Question 5, which type of term insurance decreases in death benefit over time? Well, there's a big fat duh. It's decreasing term. And we talked about it. It's mortgage, it's credit life, meaning the death benefit goes down because the balance of the debt that it's covering will also go down. And then we also talked about a lot of new insurance agents sell mortgage life or credit life because it's cheaper, and I'm not going to say easier, but there's an easier market for it because many people have mortgages. When do income payments begin with an let me give you a little bonus here, helping you out. So a good thing to do as an insurance agent is networking. So if you're working for a company and one of the products they have that they push for you to sell, or it's going to be your specialty that you've chosen, is mortgage life, then go meet with some loan officers and say, hey, when you have I was a loan officer for 15 years. I never had a life insurance agent approach me and say, hey, if you sell, a mortgage to such people, could you hand them my card and say, hey, this guy sells mortgage? And we didn't sell it as a company. We didn't offer it. We didn't ever talk about it. And could you recommend me and say, hey, would you give, here's this guy's information. Could you, reach out to him and he'll help you protect the loan you just got on the biggest asset you'll ever have in your entire life. And that's what I would do as a salesperson. That's what I would say. And then, you have, it's probably not a slam dunk ironclad lead, but it's pretty warm if that person gives you a call. Because first of all, they have picked up the phone and give you a call. Now you can maybe do it where he provides you their contact information, but they're probably not going to want to do that. Just because worst thing to happen when you start getting into financial situations is then you start getting a bunch of calls and you're like, oh, how did you get my information? Oh, well, your loan officer gave it to me. Well, there's probably some legality issues to that, number one, and it just kind of makes you look really bad. So they're probably not going to do that. But if they hand a card to somebody and say, hey, reach out to this guy, and they actually call you, that's a hot lead. I'm not even call that warm. I'm gonna call that hot. So just a little free tip there for you. Might make you some money in the future. When do income payments begin with an immediate annuity? We talked about this within 1 year. Joint life or a quote unquote first to die policies pay the death benefit when the first insured die. Survivorship life policies are primarily used for estate planning. We went over that ad nauseum. And then which annuity payout option provides payments for life with nothing to the beneficiaries? Another kind of big fat duh, life only. Now here's the good thing about this is these questions, these were taken directly from tests, actual tests. The pool that every state uses to create their test, these are in there. Now, that's the good news. The bad news is there's 3,000 questions they can pull from, or they can choose. So you got to know your stuff. What is the accumulation period in the annuity? When the premiums are paid and the value grows. Let's submit and see how we did. Yay, we got 100. We're feeling good about ourselves. Woo. All right, it's almost 1 o'clock. And again, at 1:30, we're going to take a longer break. And then when we come back from the longer break, we're going to go into the health content. And again, the very beginning of health content is a lot about contract law and stuff like that. So now, and that'll be from 2:30 to 5:30. So it's only going to be a few hours. I see a raised hand. If you have a question or something, or I don't know if you're accidentally raising your hand, you can throw your questions in the Q&A or the chat. So if you have a question, because there's too many people in here for me to do unmuting because it gets chaotic. So just too many people. But if you have a question, throw it in the chat or the Q&A, and I will address it. I'm trying to see them all, but I don't see any right now. Big section, very testable stuff here is policy riders, provisions, options, and exclusions. I call policy riders. Yes, this live is being recorded and it's being uploaded to the cloud, and it will be loaded on your dashboard within a couple of days after this live session. It takes them a while to get them transferred over or whatever. And then if you don't get it within a couple days or something, I make sure I have your email address, and I'll email you a link to it. But yes, this is being recorded, and I got it recorded before I got into any of the content, but I did start a little bit late. I talked a lot before that, but it was mostly nonsense. So, which is a lot of what I say. No, I'm just kidding. I say most everything I say has a point. It might not sound like it because I'm a rabbit trail type person and I got a million stories for everything because I'm old. But anyway, I try not to get on a lot of rabbit trails. I want you to get the most amount of value, but I also want you to stay awake. So usually, one thing that I usually do, but I was trying to mix it up today, is a few minutes before the break, I try to tell, and I know some people that are in here have been in my most recent study sessions, also. So they're hearing a lot of the same things over again. Um, but the other thing I'm doing is as I go through this content, I'll be honest with you. Sometimes I like look at the content and I don't know it as well as I should. So throughout the week, I go and I pick up my son who goes to school about 30 minutes away, and I will listen to videos on this content so that I get sharper with the information. So I understand it better. Because I was actually murky on the payout options for annuities. And as I was saying some things, it like wasn't ringing true to me, like it didn't sound right. So I watched some videos and I actually was right, but I didn't have a lot of uh, extra information to reinforce what I was talking about. So I learned how to explain it better. And again, I'm always trying to get better. I am a continuous improvement type of a person. So, and I wasn't feeling very good about my content there for a minute. So, but policy writers, I don't know why. It's one of my favorites. I think it's because I understand it a lot fully. And I use the example of fast food back in the 1970s, early 80s. A lot of fast food companies, everything was a la carte. So now, an interesting watch, if you watch movies, is a movie called The Founder about the origins of McDonald's and Ray Kroc, who wasn't the founder, but you'll learn why it's called that when you watch the movie. It's got Michael Keaton in it, plays Ray Kroc, and the premise of it might sound boring, but it's a really good movie, and it talks about how McDonald's came to be what it is today. And but if you can Google and look up the menus from like the 1970s, early 80s, and they'll make you sick about how much things cost. You could probably get a cheeseburger for 59 cents or something like that. Um, and I remember when a Big Mac value meal was $2.99. And then you could literally supersize it for 79 cents. But I say all that to say this. They didn't have combo meals. So you would order a hamburger or a cheeseburger. And then the person behind the counter would say, "Do you want fries with that?" Well, these riders are the French fries. These riders are a soda or a pop. Um, they're add-ons to existing insurance policies. So riders are add-ons. They're optional. And then provisions are um, on every single life insurance policy. It's a provision. It's part of it. It's something to explain how it works. Options are a lot like riders. They're optional things you can add to a policy. And exclusions. Um, those are things on policies that cause them not to be paid out. And again, we'll get into all these. We may not get into it with life, but this stuff all applies also to health. So, and when we come back, I'll kind of get a feel for everybody that if we want to keep powering through life, but I'm going to guess with the amount of people we have that started in the beginning that we're also doing health or just doing health, they're going to want me to transition into health, and that's fine. But we'll get a pulse of that after we come back from the long break. So policy riders, provisions, options, and exclusions. We're on riders, which are add-ons. So you want fries with that. And these come about by using the term that I told you, tell me about. So learning about people's situation. So you're talking to a potential client and you say, tell me about your job. Tell me about your spouse. Tell me about your kids. Tell me about your house. Tell me about your car. Tell me about your dog. Tell me about your parents. Whatever it is, tell me about. People love talking about themselves. As I was telling this before on a different class, when I was a loan officer, I had a call and I was doing the tell me abouts, and a lady said to me, I asked her what her job was. Tell me about your job. And she said she worked for Hostess. And I said, I'm very familiar with your product. And she said, you're not familiar with my product? And I said, no, 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 ma'am. You misheard me. I said, I am very familiar with your product. And she laughed. And, obviously Hostess makes Twinkies, Hostess makes Ding Dongs, whatever. And I'm very familiar with those products. You can look at my face and know I've had a Twinkie in this face. So up until that point, that call was very cold. I was a salesperson, and she did not like it. She was talking to me because she was interested. She did reach out, but man, she was cold. It was not a warm call at all. And after that joke, self-deprecating, she breathed, sigh of relief, and then I became a friend. And then we kept talking, and probably about 10 or 15 minutes into that call, she um she said, what is this about? And I again, I say all that to say this. um I was just becoming her friend. I was learning about her, and as I was saying all that, I was qualifying her loan. I was learning about her particular needs. And then by the time it got to the point, 15 minutes in, I kind of knew her a little bit. Again, I knew what bored her and I knew what made her laugh. And then I'm like, oh yeah, you filled out a lower my bills, application, and I'm with Ace Mortgage, and I'm just calling to talk about, getting you the cash out that you need to pay off your bills and, renovate your kitchen or whatever. And then she's like, oh, okay, yeah, I want to do all that. And so, and by that time, I kind of had an idea of what her needs were. And the same way in this situation, you've learned that, yeah, they're, concerned about their life. They have 2 kids. They have cars and houses and all that kind of stuff. And you would say, you know what, uh you need this kind of policy, or you don't need this kind of policy. And I'm here to tell you, if you tell somebody they don't need something, knowing that you could try to sell them that and make more money, but you say, you know what, at this point, you don't really need a whole life policy uh, that has all these extra bells and whistles, they're really going to trust you because they know that you're actually listening to them and looking out for their best interest. And that's what these riders are. So the first rider we're going to talk about is the waiver of premium rider. So, and it's a monthly deduction, waives premiums during disability, also known as like a disability rider. So you have this insurance policy, something happens, you become disabled. After 6 months, you get a letter from a healthcare professional. You provide that to the insurance company, and you have your health insurance or your life insurance policy, and you don't have to make premium payments any longer. Good deal. Good deal, right? That's if you buy that rider, and it's an add-on. So, and guess what? It adds premium. Now, if the person's not concerned about that, maybe they're like me. They're not adventurous. They're not, rock climbing anymore. They don't have four wheelers. They don't, I call it a nerfy life. I'm living a pretty nerfy life. I've done dangerous things in the past. Don't do it much anymore. And so this may not be important to me. And again, if you find out that that's the way that people are, they don't fly a lot, they don't travel a lot, they don't have a whole lot of adventures, not likely to become disabled. And I'm not saying it's 100%, but this might not interest them. It's not that important to them. And again, that's what you're finding out. Guaranteed insurability rider add-on. So this is a good one. This is a good one for a young person. Let's say you have a person that's fresh out of college. They're in their first job. You know, it's entry level. They're not making a lot of money yet, but there's advancement potential, and they're, you know, goal oriented and goal driven, and they want to climb the corporate ladder. Then you get them a guaranteed insurability rider, an add-on, and that means they can add coverage with no medical exam at specific ages or triggered by life events. And the specific ages are like 25, 28, 31, 34, 37, and 40. Now, they cut it off at 40, basically because that's when, if you've ever turned 40, like myself, and I've turned 50, like myself, I haven't turned 60 yet, but your life changes and things slow down, and so these are you become more of a health risk to an insurance company. That's why they cut these off, the guaranteed insurability riders, at 40. But the way this will be questioned from a testing standpoint is guaranteed insurability rider. You can purchase additional coverage without a medical exam, and then the answer will be at specific ages. It probably won't list the ages. It's probably a moot point. And then also could be triggered by life events. So again, if you're young, you're just out of college, you're starting out, you're probably not married yet, but you get married. So then you can prove with a marriage license to your insurance company, hey, I got married. I need to increase my death benefit so that my spouse is more secure. And then they do that. But that's only if they add a guaranteed insurability rider to their insurance policy. And then maybe they have kids, so they need to add beneficiaries and add more coverage because they had kids. So that would be a life event. Or they buy a house and they need to add more coverage because now they have an asset, what have you. The bottom line is it's a policy rider, it's an add-on, and it's called guaranteed insurability. Then you have a pay or benefit rider. That's exactly how it's listed, pay or benefit rider. So if the payor dies or becomes disabled, it pays the premium. Now, this is when the payor is not the insured, obviously, because if you die, this isn't really going to help you much, is it? This is on juvenile policies. Could also be used on a policy where you're insuring somebody else's life, your spouse or a subordinate like employee, but usually these are on juvenile policies, so it's your kids. And that way, if something happens to you, that person, the actual insured, which would be the kid in this case, the juvenile, they don't have to continue to make payments after the policy holder, which would be the parent, passes away. So it's a rider called the pay or benefit rider that continues to pay for the policy after the policy holder or the payor dies, the person paying for the policy. So here's a few more policy riders. Accidental death, and I'm gonna kind of go through these quickly. I'm going to try, I don't think I'm going to make it to another test. I'm going to try to make it that far, I would say, to about 16. But accidental death and dismemberment, also known as an AD&D. It's kind of a common policy rider. So it provides additional benefits for accidental death. So in this case, it would be like you have $100,000 of a death benefit on a term life policy, and you add an AD&D policy to that. It could be whole life as well. In this case, it doesn't matter. You add an AD&D, say $50,000. So in the case that you die in an accident, you get a bigger death benefit. All right, Fernando, thanks for being here. Appreciate you. Thanks for hanging with me. And yeah, I'll send that out, and then make sure you keep my email address and let me know how you do when you take your test, because it fires me up when I hear people pass the test, because you're going to pass your test because we're being positive. So AD&D, the death benefit. Yes, thank you, sir. The death benefit would be more. So if you die and your face value is 100, but you die because of an accident, your death benefit is now 150. So why would that be important? There's a couple of reasons why it would be important. Someone dies in an accident, like a car accident or something. That's a traumatic experience. There's probably a loss of some sort of there's collateral loss in that, maybe a car or something like that, or who knows, a house fire. So that extra money can cover things that arise due to that accident. That's why you would have one of these. Or part of the AD&D would also be dismemberment. So let's say something happens and you lose a limb, or you go blind, or you go deaf. You get living benefits. You can get living benefits from a death benefit on an insurance policy. And what that means is you're still alive, but you're left, you don't have a hand, or you don't have a leg, or you're blind, or you're deaf. Well, you can accelerate your benefits to help you. So again, in this case, we have a $100,000 death benefit, $50,000 AD&D policy on top of that. So you become dismembered, they pay that $50,000 to you while you're alive to help compensate for income that you lost, maybe retraining, to do something different, or accommodations that you need, wheelchairs, what have you. The little stick that you carry if you're blind, and if there's any blind people, I'm not being joking, but I will tell a quick funny story again, because I kind of like to break up the monotony a little bit. But I ran a 10K. It's going on 15 years ago now, and it's just one of my bucket list items. And it was on Thanksgiving Day. So Thanksgiving morning 10K, which is 6.2 miles, and it was in downtown Cincinnati. And it was me and my buddy, and we're both kind of bigger guys, and we trained for a while to run this 10K. Some people are in good shape and they can just fall out of bed and go run a 10K, no problem. That was not the case for us, and I couldn't do it right now. Recently did a 5K, and it was one of the hardest things I did in a long time because I hadn't done one. And again, I'm older, my joints are stiffer, and just whatever. I'm just out of shape. Well, did this 10K, and we were getting towards the end. There's a lot of funny stories that go around this 10K, but I'll just tell the one that applies to what I just said. And just ahead of us, towards the end, there was a blind guy running, and he had the little stick, and he was running, and he was tapping the little stick. And we were a little ways behind him. And my friend, his name is Nate. Nate yelled at me and said, "We can't let the blind guy beat us." And I said, "Dude, first of all, that guy actually looks like a runner. We do not look like runners. And I said, and second of all, since he's blind, he heard you. So yeah, we did beat the blind guy. We caught up with him and passed him. He had a person with him that was helping, and but I thought that was a funny thing that happened. And out of like 15 or 16,000 people that were in the 10K, we came in like 10,000th place, 10,100th place. But anyway, so if you become blind, you get a payout while you're living on an AD&D rider, which is an add-on to a traditional life policy. And then term riders, before our break, we'll just get through this page. And then again, we'll transition over to a break, and then we'll come back and we'll finish out the day talking about health. So term rider, and like I was saying earlier, if you watch old people TV, then you will hear life insurance ads. And one thing that you hear in a life insurance ad, they'll say the term riders. I've heard it my whole life because I've watched a lot of old people TV in my life. And so it adds term insurance to a permanent policy. Another name for permanent policy is a whole life policy. And so you have a whole life policy, a policy that builds cash value. It's good for your life. You can add a term policy to that. So let's say you get a $100,000 term life policy. Then you add a 10-year $100,000 term policy on top of that. So for the first 10 years of you owning that policy, if you passed away, your death benefit would be $200,000 instead of $100,000. And it would be a much cheaper way to get that amount of coverage because you added it on as a term rider. And then it's cost-effective, temporary coverage increase. But then after 20 years, after 10 years, that term rider will drop off, and then your death benefit then would be $100,000 on your whole life policy. But then if you chose another certain rider, then maybe at that time you can increase your death benefit on your whole life policy because you're in a different place in your life. You're older. Maybe your house is paid off now. Your cars are paid off now. So you can use the money for the things that you were doing for that to apply towards your life insurance. This is what you'll say when you're selling. Like if someone's literally asking you, well, why would I do that? Well, this is the reason. And you knowing it puts you in a position where you are the expert, and then they trust you, and then they want to use you as their agent. And then other insureds. We've talked about this in one application already with survivorship life. But other insureds covers spouse, children under the same policy. So this is not necessarily survivorship life, but it acts like survivorship life, where you have the $100,000 death benefit, but it also covers the other people. But these would be a second to die or a third to die. That term really doesn't exist. In order for this policy to pay out, everybody would have to die. So it's kind of sad, but but it covers. It's an umbrella policy for multiple people. So I can give you a bunch of different applications of where you would use it, but the bottom line is it's a policy rider or an add-on called other insureds that can cover your spouse and your children under the same policy with the same death benefit. And then you have long-term care, which accelerates the death benefit for long-term care expenses. Now, this is likely going to be attached to a whole life policy. For testing purposes, that's neither here nor there. Just know it. Because they're not going to they're not going to pay a lot of living benefits on a temporary type policy. It's just not going to happen. But long-term care accelerates the death benefit for long-term. So you get put in a nursing home for whatever reason. It's a car accident, it's a disease, a major health problem, and you end up in a long-term care facility or a nursing home. Then you know how, if you know anything about nursing homes, they are bloodthirsty. They want money, and maybe your family has no money to pay for you to be in that. Well, if you have this rider, long-term care rider, on your health or life insurance policy, you can accelerate your death benefit, either half or all of your death benefit, to pay for your long-term care. Now, you probably won't want to take it all because you're still going to die at some point. You're still going to need a certain amount of money for your burial. So maybe you take half of what your policy is, or 75%, and you prepay your stay in the nursing home. Now, typically there's going to be a 6-month waiting period for them to accelerate that death benefit. They're going to make sure it's really truly long-term care. But this is a policy rider, so it might work differently than that. The bottom line is you have this, and that's what it's designed to do. That's what it's designed to cover. And then this little note here is, think of it as riders. Think of riders as superpowers for your policy. Let's see, what's the next page? Okay, this is short, so we can probably cover this next page before the break, since just a couple minutes. We'll go from 1:30 to 2:30 on the break, and then we'll come back and we'll finish out our day. And then hopefully most of you stay, but we'll get into health after that. Maybe we'll talk about it when we come back, and then we will decide how we're going to finish the day. But anyway, bottom line is I'm going to finish this page. We've already talked ad nauseum about return of premiums, but as a rider, as opposed to a return of premium policy. So I kind of look at this as like the toppings on a pizza. You have a Hawaiian pizza that has pineapple and onions and ham, but if you get a cheese pizza and you add pineapple, the return of premium rider is like adding pineapple. So it's not a return of premium policy, but it's a regular life insurance policy that has a return of premiums. Now, this is on a term type policy only because it just makes sense. You have a certain term, it goes for 10 years. You add this rider to the 10-year term policy. Then after that 10 years, all the premiums that you had paid up to that point get paid back to you. It has to be a term policy, because if it was permanent, then you're not going to get your premiums back. And then that'd be a cancellation or a forfeiture type policy. It just doesn't work. And then we've already talked about it, monthly income during disability. So it's a disability, well, not really. Disability income rider is if you're deemed disabled. This is a living benefit to a life insurance policy that you get paid X amount of dollars per month while you're disabled. And these can be a lot better and more cost effective than a separate like disability insurance, like an AFLAC or something like that. As a rider, these can be much more affordable. So it's something you would definitely want to offer to your clients, again, because your premiums are going to be higher, you're going to make more money, and they're going to have the things that they want. And then cost of living, or a COLA rider, meaning your benefits increase annually based on the consumer price index. So the consumer price index measures the amount of inflation on a year-over-year basis. Well, it calculates it like on a month-to-month basis, but this would increase your benefits annually based on inflation. So in other words, if you get $100,000 policy and you get that policy in the year 2000, and now we're in 2025, $100,000 covers a lot less in 2025 than it does in 2000. But if you got a COLA rider on your policy, and let's just use 3% as the consumer price index per year over year, then by 2025, the death benefit on that 100,000 is probably now 200,000, 250,000. Now, the premium's going to be a lot more. Adding that rider, it's going to be expensive, but I bet a person that did that in the year 2000 over the 25 years is pretty happy that they did it, because the face value, they don't have to reapply, they don't have to add new insurance coverages. They're it automatically goes up. Their death benefit goes up based on the consumer price index. So that's a rider, or that is an add-on. So, all right, we're going to stop there. At this point, we're going to take our long break, and we'll be back right around 2:30 ish. And go grab a bite to eat, get something to drink, rest a little bit, get caught up on college football scores for the day. I actually have to go out because there's no food in our house. We are destitute right now, so we need to go to the grocery. So I'm gonna have to go out and grab something real quick and come back. But I'll start back up around 2:30 ish. So, and I'll see you there. Hopefully, most of you come back. And if you have to drop off, I understand that. And again, if you haven't yet, drop your email either in the webinar chat or the Q&A. And once the live session is over, I'll send you out some study materials. So thank you so much, and we'll see you at 2:30. And I will put the break sign up that we're on a break. That's when it usually is, but well, I can do that, and then I can just change this. So anyway, see you guys. All right. I'm back. I used the ish a little bit. All right. So of everybody that is left in here, let me do this. Create a poll real quick. And this one back. Create. Change over to wait. Yes. Or to proceed. Okay. I just added a poll. It says yes or no, change to health, or we're basically, if it's no, we stay with health or life. If it's yes, we stay with life. If it's no, we stay with. I confused myself. So far, it's 50-50. Now, also, I mean, keep in mind with this, um, there's in the first part of health, there's a lot of crossover back to life. And then also in the next part of life, there's a lot of crossover to health. So it wouldn't be damaging for any of it. So it looks like it's staying 50-50. Really hope that doesn't follow. So no means we'll stick with life. Yes means we'll change to health. Right now it's 50-50. So it'll be a coin flip at this point. It won't be a problem for life people if we switch over to health. Trust me. Staying with life is winning. You're still with us? Take the poll. Let the majority rule. This is a democracy. Right now, it looks like we're staying with life. Once we get some more votes. So far, there's 14 people left in here, and half of everybody has voted. So I'd like to see a few more votes on if you vote no, it means we're going to stay with life. If you vote yes, we're changing over to health. So I'd like to see a few more votes out of the rest. Don't be neutral out there. Don't be Sweden. Because I want to provide the most amount of benefit for everybody. I can send what? Send the poll again? Oh, it still shows that it's active. Life is fine. So you get to, so that would be another one in the no column. Be getting close to damning on that one. All right, I'll wait about 30 seconds for any more votes. And then we will proceed. Like I said, there's good stuff. Yeah, this next is provisions, and it's a lot about contract stuff, so it applies to health as well. A lot of the content reads exactly the same. I think I can probably go to the end of the day without a break. I'll get you guys more as well. I think what I'll do actually is the last say half hour, 45 minutes. I'm going to go over one page of health that um, is health only. And that way, all you life folks, you'll get the maximum amount. And then you health folks can get those few things to kind of patch in. That's just the health only stuff, the stuff that has to do with like Medicare parts and stuff like that. So we'll do it that way. But it's cool that we still have 15 in. Usually a lot of people drop out. Sometimes I end up with less than 10 in the last section. Check the Q&A real quick, make sure there's nothing I need to address. Looks good. All right, so policy provision. So we talked about riders. So riders are optional things. You want fries with that. Um, this is more of like okay, you order a cheese pizza, it's gonna have cheese on it. And usually closer towards the end of the day, my food analogies increase, but I've already eaten, so they should be few and far between. It's just so applicable. It's so easy to draw the similarities between food and this stuff. So, but policy provisions are on every single policy, and this also again applies to health as well. So, an entire contract. So that is the term, entire contract, and that is the policy itself, and the application equals the entire contract. So basically, the original application that's taken by the agent follows the policy throughout its life. And it allows for a few different things. Basically, it allows underwriters to verify things. It allows them adjusters to verify things when the claims are made, and they can go back to the original application and figure out if anything needs to be adjusted. Because if it's definitely within a certain period of time, things can change, benefits can be denied or canceled. And if it's after, only certain things can be dealt with. We'll get into that as well. But just know that this is the way it'll be tested on. This is the way the question will be asked: is what constitutes an entire contract, and that is the policy plus the application. And then the second one is the insuring clause. That is the company's promise to pay benefits. So insuring clause, company's promise to pay benefits. So their contractual obligation to, if you get a life insurance policy with a $50,000 face value and you die within a certain period of time, and everything's on the up and up, then the insurance company promises to pay that death benefit to your beneficiaries. That is the insuring clause. Then you have free look. 10 to 30-day examination period in order to review the policy once it's been delivered, and then decide if you want to proceed or keep the policy. But it's 10 to 30 days. And then if you decide to cancel, if the insured decides to cancel, then a full refund of the first premium will be issued and the policy will be canceled at that time. It's not, as an insurance salesperson, you don't want that to happen because there goes your commission. So you want them to keep their policy. So again, that's just all about doing a good job, figuring out what they want and making sure everything is how they agreed to it when the policy is delivered. And then consideration. This is a contract term. Consideration. The two sides of this are the premium is from the applicant, an application. That's your obligation to getting an insurance contract. So the two sides of this contract are that, and then the insuring clause or the consideration from the insurer is the promise to pay. So now you're going to learn on the next page that it's an unbalanced contract because they have to pay as long as you maintain premiums on the policy, but you don't have any legal obligation to keep making payments. Now, your policy will lapse, or the insured's policy will lapse, but there's no ramifications to it except for the policy going away. So there's no collections, there's no penalty. It just goes away. But the insurer, they are obligated. So these policy provisions are as follows. Are those things that we just talked about. So next we're going to go into the owner's rights and beneficiaries. So again, the owner on a policy is not necessarily the insured. It's the person who holds the insurance policy. This is on a life insurance. Some of these apply to term, some of these apply only to whole, and you'll see that. And it'll also help you as we go through these. It'll help you understand some previous content about the difference between term and whole life when we go over these terms. So an owner's right on a life insurance policy, they can change beneficiaries. So as long as, but you go down here, so you can change beneficiaries based on this right here. So if you have what's known as a revocable beneficiary, then you have the full right to change beneficiaries as you want. Now, it has to be done in writing. It has to be official. Everything has to be on the up and up. But a irrevocable, you can't. That is a type of beneficiary. A lot of these will come in the event of a what do you call a prenuptial agreement between people getting married. So one thing that they might want as part of their marital contract is a irrevocable life insurance policy. So maybe you see these these younger women, and they're marrying much older, wealthier men, and part of their marital agreement to marry the older man is they want $1 million irrevocable life insurance policy, meaning that even if that they get angry or something happens and they get a divorce, they still are the beneficiary on that life insurance policy unless they agree to be removed. So that's an irrevocable beneficiary. And then an owner also has a right to assign a policy or borrow. So borrow only applies to a whole life policy, a insurance policy that has a cash value. So and then assigning a policy is a whole different ball of wax. There's something called a viatical settlement on a life insurance policy. So let's say something happens, you get diagnosed with some sort of a terminal illness, and you want to get cash out of your life insurance policy. This again only is going to work on a permanent or a whole life insurance policy, where you can sell that policy to a viatical company or a third party, and you can assign it to them, basically making them the beneficiary. In that case, it would be an irrevocable beneficiary. And then in the event of your death, they get the death benefit. So they might give you, if you have $1 million life insurance policy and you want $500,000 right now, they may give you that $500,000 up front. And then when you die, they get the full million. So yes, they are out, the money at the moment, but they know when that insurance pays out, it's going to pay out $1 million. They're going to make $500,000 on that transaction. So insurance companies are kind of changing their rules and their guidelines on this. They're trying to make these less common or less popular by allowing you to cash out a portion of your life insurance policy early, so you don't end up in one of these viatical settlements, and that's a surrender policy situation. And then another thing that you have as an owner's rights of an insurance policy is when you get it, you can select what options you want. So meaning you can select riders and then options that we're going to find out on the next couple pages. You have an order of beneficiaries. We know that beneficiaries are the people that receive the death benefit upon the death of the insured. So you have primary and contingent. So with primary, that would be, the best way I can describe that is husband and a wife, and the wife is the primary beneficiary, and the husband passes away, and the wife is the beneficiary. Well, if there are others, so after the wife, the oldest children, the younger children, they become the secondary or tertiary beneficiaries. It could be an aunt or an uncle, some person in the family named as beneficiary. And then if there are no beneficiaries, then the money would go to the state in what's called probate, and then the state would work to decide where the money is supposed to go. And you don't want that to happen. That's a mess. That can take months and months, if not years. Then you have common disaster. We talked about revocable, irrevocable. You have a common disaster, which is a simultaneous death clause. So, meaning if the insured and the primary beneficiary pass away, it automatically goes to the contingent beneficiaries. And then, that can go on down the line, because if a primary and then one of the contingent pass away and the primary, you can name as many beneficiaries as you have and as many as you need. So, and then there's those people out there that name their beneficiaries as their cat. It doesn't always have to be a person. Now, I've always been one of these people that's like, hey, if you name your cat as your beneficiary on your $1 million life insurance policy, I will take care of that cat. No problem. Just give me the $1 million. I will make sure that cat has a wonderful life. So they would be a feline beneficiary. So common disaster, that's basically the insured and some beneficiaries pass away, so it keeps going down the line to the contingent beneficiaries. And then minor beneficiaries would require a guardian. A minor has no ability to enter into a contract. They have no ability to manage funds, even if they're, mentally or they have experience. They're just not legally allowed to do it. So a minor beneficiaries require a guardian. So you will have to name someone. And we had someone mention trusts in the Q&A earlier on. That would be a good time for a trust. And so you have minor beneficiaries on a life insurance policy, and you don't, you have $1 million left to the kids. And, so someone has to manage those funds to make sure it goes to the kids at the appropriate time and the way that the insured intended it for to go to the kids, or to just literally take care of them. And then they have funds in order to take on the burden of raising somebody else's kid. And then the class designation is basically how that would be worded in the contract. And this is the way that the question would be asked is, what is the class designation regarding beneficiaries in a, all right, Angel, I see you there. Yep, I'll send you out the content. Thank you for the kind words. I appreciate you. I appreciate you being here. So class designations on an insurance policy contract, they will designate my children, my spouse. Those are the examples that they're going to use, but that could be my uncle, my aunt, my parent, my grandparent. That it's just in quotes describing who the person is. So it will name them specifically, and then it'll give them a class designation right after. And the reason for this, which again, with this kind of stuff, it helps to know the reason, is the fact that you don't want there to be any ambiguity on this. You want everything to be clear, because again, if you have somebody named in there and you don't put a class designation on it, and there's another family member that happens to have the same name or very similar name, they can come and say, well, they meant me. They told me they meant me. And then the court has to hash it all out. But if you put my children or my spouse or so-and-so, my uncle, then it kind of squashes that ambiguity. All right. This one, pretty simple stuff right here. If you've ever had, automobile insurance, any other kind of insurance, you know what a premium is. But there are some things to know here. And honestly, just about every one of these could have a test alert flag. When I developed this, I had it put test alert flags on likely questions. Well, there are 3 likely questions on this particular page right here. So you might gain 3 points on your test just by studying this page, and they're pretty easy. So premium payment. So again, when you get car insurance, they're like, you want to pay that annually? Usually not, because car insurance usually goes by 6 months. But semi-annually, quarterly, or monthly. You can do home insurance annually. But those are your modes of payment: annual, semi-annual, quarterly, monthly. And then grace period, 30 to 31 days after the due date. That's the way that question will be answered. What is the grace period for a life insurance premium payment? 30 to 31 days. They just went by the months. Months have 30 to 31 days, and they just ignored February. And then automatic premium loan prevents lapse in coverage. So that only applies to whole life or permanent life insurance, because term life policies do not have a cash value. So how this works, and we'll get more into it in the coming pages. So how this works is, if you have a $100,000 whole life policy, you've been paying on it for 5 years. Let's say your cash value is around, let's say $10,000 on the policy, and you stop making your premium payment. Well, this is a provision, so this is already on there. It's not something you have to choose. It's not a rider. It's not an option. It's already on there. Your cash value will cover your premiums as long as you have cash value. So if your premium is $100 a month, then, and you have a $10,000 cash value, you have about 8 years worth of premiums that you've got covered by your cash value. So you're not going to lose that coverage for a while. So you've got your death benefit. Now your cash value is going to go down, and it's going to be a loan. So there's going to be an interest rate attached to it. If you want to pay it back, you're going to have to pay a little bit more, but it is on there. It's a provision. I'm a creature of habit. So I have to say certain things. Back in the 80s and 90s, there was commercials for Ragu spaghetti sauce, and how they always worked is they would show some guy or something in the kitchen, and he would open the jar, and he would pour a couple jars of spaghetti sauce, and there'd be a big Italian family there, and the mom would come in and see him pouring jarred spaghetti sauce into a pot, and she would be horrified, because she always made her sauce from scratch by hand, and she's like, how dare you serve this Italian family ragu spaghetti sauce? And then she says, well, what about the oregano? And he would say, Ma, that's in there. Or she'd say, what about the whatever basil? Mom, it's in there. What about the garlic? It's in there. And so the term or the tagline of ragu spaghetti sauce was, it's in there. So a provision is like ragu spaghetti sauce. It's in there. So, and then this is going to be explained kind of on the next few pages here. So, and this isn't kind of something I should probably get rid of, but it'll be explained on the next page. So, grace period is your oops, I forgot safety net. So, but the last thing we'll cover in this next section here. So, the cool thing about a whole life policy is, let's say you run out of cash value, but you want to get that policy back. Then you can go all the way out to 3 years and restore a lapsed life insurance policy back to and get your death benefit back. So, and you just have to pay all the back premiums plus interest. So all that, those premiums you should have paid plus the interest. Now, if it was like a premium loan, you don't necessarily have to pay the premiums that were covered by the cash value. That can just kind of go away. But to get your your thing reestablished, let's say you went 1 year after your cash value expired, then you've got to pay your 1 year of premiums plus the interest on the loan in order to reestablish that insurance policy. But the test question would be um, basically, what is the time period for reinstatement on a lapsed whole life insurance policy? And the answer would be 3 years. So, and then loans, withdrawals, surrenders. So you have the ability for the whole life or a permanent life policy to borrow against the cash value. And that has, like we've already said, that has a interest rate attached to it. Uh, Having that loan does not affect your death benefit necessarily, but if you do have a loan uh, and you die, whenever they pay out the death benefit, they will repay the loan with the death benefit plus interest. So they will get that money back. Now, again, if you die and you have $100,000 loan and it has a $50,000 cash value, your payout would be, your death benefit would be $150,000. But let's say you have a $5,000 loan on that, and there was $500 in interest. Well, they're going to take the $5,500 out of your cash value. So they're going to repay that loan, and they're going to take $500 to cover the interest. So, and then you still get your, so your payout would be like 144,500, something like that, or 140,500. So that's what happens with a loan. And then withdrawals, that's just taking out your cash value of a whole life policy, often known as a hardship withdrawal. And again, I dealt with these a lot when I was in the mortgage industry, because we would have people use the cash value of their whole life policies in order to put a down payment on their house. So we would provide them a copy of their of our good faith estimate, and then they would send that into their mortgage company, and they would send that into their insurance company, and their insurance company would cut them a check. Now that's not a loan. That they would just take out their cash. And just to kind of get a little ahead of ourselves why it's applicable, that is a non-forfeiture option. So meaning you do not surrender the death benefit, but you're just taking the cash value of the whole life or permanent life policy out, but you're not forfeiting the policy itself. You're just taking the cash value. And then you can also do a partial surrender. So, meaning you get to a point in your life, you no longer need as much coverage as you had. So you can partially surrender your policy to reduce your death benefit, to either get lower premiums, maybe use your cash value, and that's down here. That's your reduced paid up option. So this is a partial surrender, but it's non-forfeiture. You're not forfeiting the policy. You're just changing it. You're modifying it. And keep in mind, these are provisions of a whole life policy. These are things that are in whole life policies. These are not add-ons. They're just in there. So a reduced paid up option means you take your cash value, or you take X amount of dollars, you pay up the rest of your premiums, and you just have a smaller death benefit, but you don't have a policy premium anymore. Maybe you retired and you don't have, your income goes down in retirement because you're only drawing a small pension and Social Security. then you would, in that situation, you would have a reduced paid up, and then you would have smaller permanent coverage. That's a partial surrender, and it's non-forfeiture. You still have your death benefit. And then the next would be extended term. So on a term policy, a non-forfeiture option on a term policy is extending the term. Now, in this case, this is an option. Okay, so this isn't on every single term policy. This is an option on a term policy. So you would have to actually choose this, an extended term. And we talked about that. So this is general terms that call back to riders. Okay, so this is explaining what the rider is if you renew the policy. It's an extended term non-forfeiture option. And then the cash surrender value are options on a whole life policy. Reduced paid up is on a whole life policy. But extended term is an option on a term policy where you can, and again, we saw that on term. There's annually renewable and just regular renewable term policies where you can renew either at life events or at certain ages. Dividends. These are fun. So dividends are basically money paid to policyholders where, let's say, an insurance company has a good year. They don't pay out as much claims as they thought they were. And so basically they collected more premiums than they needed to. So if you have what's known as a participating company, these pay dividends. So P and P, participating. So that would be you buy a life insurance policy from a participating company, which hopefully your agent would tell you that, and then also let them know that, hey, I can get you this policy through a participating life insurance company, and if they have a good year, they could pay dividends. So maybe the coverage is a little more expensive up front. Maybe the qualifications is a little bit more. So, one thing that I recall in dealing with clients is making them feel special or making them feel, in like they're in a certain class. They like that. So you can say, hey, you're in great health. You're X amount of years old. I can put you with a participating insurance company that potentially will pay you dividends. And, if they have a good year, then you can use the options of the dividends to just get cash. They can reduce your premiums, or you can buy additional insurance coverage using the money. You're in control. But a non-participating insurance company just doesn't pay any dividends, which is probably most insurance companies don't pay dividends. But for testing purposes, just know that participating companies pay dividends and non-participating companies don't pay dividends. And that the things that you can do, and I've seen all of these items tested, how you can use dividends, cash, lowering your premiums, and buying additional coverage. So incontestability, we're going to talk about this a lot over the next few slides. So incontestability, which is most things an insurer, after you've had your coverage for 2 years, they can no longer challenge your claim. A lot of times what this is talking about is suicide. So we had a Colorado person in here. I don't know if they're still in here, but other than Colorado, and I've never really verified this, probably should have, to keep talking about it. It happened a couple classes ago that I was teaching. The general guideline for suicide in a life insurance policy is 2 years. So if you are within 2 years, or what's known as the contestability period, and you commit suicide, that it's not going to pay out. It will just pay the premiums out that have been paid. It'll pay those back, but the death benefit will not pay. Now, after 2 years, then you go into your incontestability period, and most things the insurer cannot challenge any longer. So there are certain exceptions to that, but we'll cover those in the following pages. It's nothing that will cause the death benefit to not be fully paid, but it might only cause it to be partially paid. So, all right. So assignments. So you have 2 types of assignments. We talked about a viatical settlement, which would be an absolute assignment, meaning you personally or permanently transfer the life insurance policy to another company, so that they are now the holder of the policy. You're the insured, they're the holder. This also can apply to the insurance company, and they will transfer your policy to another company altogether. The policy remains the same, but they transfer it. That would be an absolute transfer, meaning you're with one company now, and then after they transfer it, you're with a different company. This could be for any myriad of reasons. Maybe the company is becoming insolvent. They're over-insured. They have too much on their books, and they need to dump a certain amount. Maybe they are getting out of a certain line of insurance, so they don't want to service that any longer. So they bundle them up and they go with it, and they sell them off to a company that does offer that line. So that would be an absolute assignment. And then a collateral assignment you have, that would be a temporary assignment for loan security. So let's say you have a whole life policy and you take out a $10,000 loan on your whole life policy. The insurance company transfers the loan over to Bank of America or Wells Fargo, and they handle the servicing of the loan payments. That way, they don't have to deal with something that they're not equipped to deal with. So that would be a collateral transfer of a life insurance policy. So that covers those things. And again, I find these things to be self-explanatory. I don't ever like to say easy, because anything's not easy for anybody, but self-explanatory. And this is going to cover a lot of the things that I've already said. I always kind of get a little ahead of myself because it's applicable. But suicide generally excluded within the first 2 years. Again, I had somebody in here a couple classes ago say that in Colorado, it's only 1 year. So, but generally, and I don't 100% know if that's the case, but if someone can tell me, I don't know, but generally for testing purposes, maybe your state specific part of Colorado might tell you, but suicide is excluded during the exclusionary period, which is the first 2 years of a life insurance policy. And then during that exclusion period, if someone commits suicide, their premiums are returned, but the death benefit is not paid out. Now, this is a provision which is a misstatement of age or gender. Again, this is a policy provision, and I'll explain like kind of how it works. When it's labeled as a misstatement, because you think like, well, if someone says their age is different, then they're just lying. Well, that's not necessarily true. So in order to kind of like de-escalate the situation, they've just added the misstatement of age and gender clause to cover if this happens for whatever reason, it will adjust the benefit to correct the premium. So now this can go both ways. Let's say someone actually is younger than what they have stated on their application, either by the stroke of a pen or maybe some misinformation. Maybe they were in foster care and it just got overlooked. And when they ordered a original birth certificate for getting a passport or some other reason, they found out their age was different. And they found out they were actually younger. Like, woohoo, right? Like, that would be awesome. So for insurance purposes, in that case, they would adjust the premiums lower. So it would actually allow you to save money, and then you would also get a refund of the overpayment of those premiums if you end up being younger. Now, if you're older, then it would correct the premium and make the premium more expensive to be whatever the age you were supposed to be at the time you took out the insurance policy. Now, in either of these cases, it does not void the policy. It's just an adjustment. So that's a misstatement of age or gender. And then as far as gender goes, if that is wrong somehow, and what a minefield I feel like that would be in today's culture, men and women are insured differently because men don't live as long. And that's just a fact. And insurance companies know it. And men are treated accordingly when it comes to life insurance. So if there's a misstatement and it's found out, then they will adjust it based on the gender, the correct gender after once it's verified. Next section is, we've already talked about these settlement options. So this is dovetailing back into a annuity settlement options, lump sum, interest only. So you can have an annuity and you can draw out only the interest because you want to provide the greatest amount of death benefit to your children. A fixed period where you only receive your payments for a certain amount of time. A fixed amount, so you need X amount of dollars that will last for however long there's money in the annuity. Or you have life income, meaning you get a certain amount for the rest of your life, guaranteed. So, and that would obviously be based on whatever the balance of the annuity, how much it has in it. Accelerated death benefits. This is very, very testable right here. Early payment for terminal illness, usually when you are given by a physician 12 to 24 months to live. And that's exactly how the question will be answered, is how is it determined early payment for accelerated death benefits? And the answer would be given 12 to 24 months to live. So then basically they pay the death benefit out. It's a living benefit to a life insurance policy because at that point in time, probably not going to work. can't work, and you're going to have medical expenses, things that you're going to need taken care of during that time. And the insurance is there to take care of that with accelerated death benefits. And the answer that you're going to be looking for is 12 to 24 months of life expectancy. All right, exclusions. Again, this applies to life and health big time. So, policy exclusions. Now, just kind of just say in this case, we're talking about life, so it's death due to war. As far as regular health insurance outside of the VA, it would be health issues due to war. So, but we're talking about life right now, and the exception is a war exclusion. So, meaning if you die during a battle, an active deployment, a general life insurance policy is not going to cover that death. It would have to go over into some sort of a VA type insurance policy, something provided by them. And but in this case, it says death due to war, and then it says declared or undeclared. And basically, what that's talking about is every time the United States enters a war, the commander-in-chief has to declare the war. The collateral definition number 13. Collateral definition. Is that on slide 13? Let's go back. Oh, under 13. Oh, collateral temporary loan. So if you have a whole life policy and you take a loan out on your whole life policy, and so again, let's say you have $100,000 with $10,000 cash value, you can take out a $10,000 loan, but you have to repay that. Well, the insurance company, let's just use Allstate, the insurance company, they will transfer the loan part of your policy over to Bank of America, and they will handle accepting your payments. So they'll send you out a payment booklet or some sort of an electronic payment schedule, and you make your payments to them, and then once you're done with that, they will send everything back over to your insurance company. So hopefully that explains that. Okay, back to policy exclusions. So I was talking about declared and undeclared wars. We often talk about the Vietnam War, or when you learn in history, they call it the Vietnam War, but it wasn't. It was never a declared war. We never declared war on Vietnam. Now, was it bad? Yes. Did a lot of people die? Absolutely. But it was not officially a declared war, as this says. So, but they're making the distinction that it doesn't matter if you die in a skirmish, then it doesn't count. Like, you do not get that benefit paid. And then this also says may include military service. Well, what does that mean? Well, let's say you're on maneuvers or in training, or just in a military aircraft, for on your way to something, and you die in that situation. There's a good chance that the insurance company is going to deny that death benefit. So that's the war exclusion. The next one is aviation. So death while piloting an aircraft. So again, that's while you're the pilot of the aircraft. If the plane crashes, whether it's your fault or whether it's the airplane's fault, the insurance policy is going to deny that death benefit. Now, it would not count if you were a commercial passenger on an airplane. If you just happened to be a pilot and you were flying somewhere on vacation, and the plane crashes, what a kick in the seat that would be. They'll pay that claim. They'll pay that death benefit. because you weren't the pilot. You didn't have any ability to affect that crash. So that's aviation. Now, also keep in mind, it may be covered in the next couple slides, but this one, this policy exclusion is going away mostly. So the question on your exam might be, what insurance policy exclusion are becoming less frequent? And that would be the aviation one, less frequent. The next one is dangerous occupation. So hazardous occupation like coal mining or something like that, something that's pretty dangerous. If you die while you're coal mining, then they're not going to pay that death benefit. But if you die in a car accident on your way to go coal mining, then that will be paid out. So, also keep in mind there's still like a hand up, but if you do have a question, please put it in the Q&A or in the chat if you have a question, and I'll keep track of them. I don't always see them because nothing necessarily pops up, but I'll keep track of my Q&A and my chat as much as I can. So now this says it may be handled through rating instead, and basically what that means is they may still give you, because again, if you go in to get insurance as a coal miner, they're probably going to be like, okay, yes, we will, but it's going to be really expensive. Meaning they would pay the death benefit if you died in an accident, but your policy premiums are going to be super, super expensive. So yes, they may do it, or they may just say, yeah, we're not going to, it depends on what you agree to in the beginning. We're not going to pay that claim if you die while you're on the job. A lot of times there's other things that cover that anyway. You get some, employer benefits that cover that just in case a workplace accident happens, such as workman's comp or something like that, which is a racket. I'll tell you, I've been dealing with it for 4 months now. We'll do this test here. All right. So the typical waiting period for waiver of premium benefits. So this is a rider, waiver of premium benefits, that you can add, that if you become disabled, the insurance company will pay the premiums, and it's 6 months. 6 months. A guaranteed insurability riders allow additional coverage purchases at, as we saw in the content, specified ages and life events. Question 3, how long is the standard grace period for premium payments? And that is 30 to 31 days. And like I said, most months have 30 or 31 days in it, and they just completely ignore February. Which beneficiary designation can be changed without consent? And that, as we talked about ad nauseum, is revocable. The incontestability clause prevents contest after 2 years. And hopefully, as I'm asking these questions, the correct answer is flashing into your brain. Usually, if I only have a few on the webinar, I'll have everybody like put the answers in the chat or something like that. But there's just too many people, even still with 17, it just gets confusing. What happens if insured commits suicide within the first 2 years? And the correct answer is, now no benefit paid is true, but the correct answer is premiums are returned. So while this is true, this is more true, and none of these other ones are true. Question 7, which non-forfeiture option uses cash value to buy term insurance? And that is extended term. And again, that is an option, not a provision. Question 8, accelerated death benefits are available when life expectancy is 12 to 24 months. The pay or benefit rider is most commonly used on juvenile policies. Juvenile. Question 10, which exclusion is becoming less common in modern policies? This is a little frustrating to me because it actually was not in the content, but I just know it. So, and that's aviation. So we're going to submit the quiz. Hey, we got 100. So good job, us. All righty. So it's 3:30. We have 2 hours left. I may take a short 15-minute break at 4 o'clock. I know I said I wasn't going to, but something I'm going to have to do. So at 4 o'clock, we'll take a quick break. And then when we come back from that break, I'm going to cover a page or two in the health content and just for the health folks that are in here. And then if you're life people, if you wanted to drop out at that point, you absolutely could. But, you know, hey, knowledge is power. So learning more things is not a terrible thing. And we've definitely gone over. I usually only make it through about 16 or 17 pages of the life, and I most of the time never make it to the second quiz. So we've gotten a lot more under the life content than we usually do. But this also all applies to health. So this is good crossover content right here. So completing the application, these are the required signatures on a life insurance or health insurance policy or car insurance or house insurance, pretty much every kind of insurance. Applicant, insured, and the agent all required signatures. And that usually this day and age, that all happens digitally, electronic signatures. And then application changes, minor changes, the agent corrects with initials. Now that's a little bit deceptive. It sounds like the agent makes a change and just initials it. No, everybody has to initial. So the agent will make the change. It could be, you know, an item that's literally crossed out, you know, and, you know, again, something minor, misspelling, you know, address, something, transposed numbers, could be any of those things. And then agent fixes it, you know, maybe using like a little caret or something like that. And then everybody initials the change. So that's acceptable. But major changes require just scrapping everything and starting from scratch with a new application. So that would be, you know, changing the type, adding a writer, you know, major changes, major fundamental changes to the to the policy. And then that you just start from scratch. And then just keep in mind the most fundamental thing about what we do is taking good applications. So taking the time, going over, not rushing through it, and making sure the application is good. Because if not, you're going to delay underwriting, possibly like slow down the issuance of the policy, you know, to a point where, you know, they can't even make a determination to issue a, you know, a conditional policy. So, and then ultimately a bad application could possibly result in an out and out rejection. So that would be the worst case scenario as an agent. So now this is you see a lot of the red and yellow test alert flags, and there's a lot here that can be tested on. And the other good part of this is again, this has good crossover between both health and life. And this is more about contract stuff right here. So a warranty is something that is guaranteed to be true. And in order for something to be guaranteed to be true, it has to be verified by a third party. So, you know, part of a contract The underwriter wants to verify, the I mean, you could go like as far as saying something like the applicant says they are not a smoker. Okay. Well, that's a representation. You asked, are you a smoker? Nope, never touched the stuff. But the underwriter orders a MIB report, which is a medical report. That'll actually be talked about on the next few pages here. And finds out that they're being treated for emphysema caused by being a lifelong smoker. Well, that representation was not true, but it was not a warranty. You know, once it's been verified, they change the application. This person absolutely is a smoker. That becomes a warranty. So that's because it's true because it's been verified. But the application contains representation. It's the truth to the best knowledge of the applicant. Back one slide, 329. There you go. So, again, warranties and representations. Representations are to the best of the knowledge, and again, it's not necessarily if something is wrong, it's not necessarily a lie. It's just that's how they know it, or that's what they think, or it literally just could be a typo or something like that. But that's what a representation is. So premium collection and receipts. Okay, so a conditional receipt is coverage pending underwriting. So basically they have coverage, but it's waiting on underwriting to approve it. So it's a conditional receipt. Now, this isn't in here, but just so you know, for your edification, if you're under a conditional receipt, it means a premium has been collected and policy has been delivered, but it's still conditional. So the only thing in the situation that's going to get paid out is if in that short period of time they died in an accident, then that if that policy is active, then it'll pay out. But underwriting in life insurance is generally pretty quick, so that would be a fluke situation, not hardly worth talking about, but it is a thing. And then a binding receipt means the coverage starts immediately, and so that would be more in the area of like a non-medical issuance policy where no medical really questions are asked, probably a burial policy for someone of a certain age. They get a binding receipt. So they get the premium, they get policy, everybody signs for it, bam, it's good to go. Binding receipt. The next thing is about replacement. So replacement is someone has an existing life policy, and you as the agent or salesperson comes in and they are like, okay, I like your policy better than what I currently have. I'm going to go with you. So you did a good job. But you got to CYA. So in order for you to cover your butt in that situation, because you definitely don't want to, if you have someone on a fixed income and you sell them basically the exact same life insurance policy that they already have, and your policy costs more money than the one they already have, and they're basically starting over, they need more time. You know, that's why you get an automatic 20-day free look period. Gives their insurance company time to be like, hey, what's the deal? You know, and then, you know, again, make sure everybody's covered and that the client isn't getting the shaft, basically. So under a replacement, the question would be is that you get an automatic 20-day free look period on replacing an existing life insurance policy with a new one. All right. So uh, required disclosures. So these are the disclosures before a policy can be issued. These disclosures need to go out. So we've, you know, most of the time you've heard about HIPAA. Generally, if you go to the doctor now at any given time, um, you have to sign a HIPAA form just about every time. My doctor now makes me pretty much sign in the day before, always when I have an appointment to go to the doctor. You get a link, they email it to you, they text it to you, then they text it to you again later in the day. Hey, check in. Don't wait to come in here to check in. We don't want you to wait till you get here to check in. And you know, you'll do electronic signatures on forms before you get there. And then HIPAA is the Health Insurance Portability and Accountability Act. Um, you know, a lot of people are like, oh, well, because of HIPAA, um, can't they can't share my health information with strangers or other people. True, that is part of HIPAA. Um, but the HIPAA form, as part of the disclosures, is allowing the doctor to share your information. So, meaning they'll say, okay, who are we allowed to share your information with? Well, you know, my spouse needs to know. Like, I had a bad heart. You know, I went to the doctor. She wasn't here with me. So, you know, she needs to know what kind of medications I'm supposed to be taking and when. And if your wife is anything like my wife, she likes to go to the doctor with me. She likes to know what the doctor says because she never trusts what I say that the doctor said is what the doctor actually said. Even though why would I lie about that? You know, but I mean, maybe. But so that's what she likes to do. But if she wasn't able to be there, I sign this form and say, yes, sure, you can share my medical information with my wife. And then an HIV consent form. Not that it's always going to happen, but you sign that form, and if they deem a necessary need in order to, you know, have one of these tests done, then they can. If you get your blood drawn, they can use the blood they drew to do an HIV test. So you consent to that. That's in a medical situation. This is in a health situation. This would be if the underwriter deems it necessary to request an HIV form. They already have the authorization on file. And then Patriot Act, that's verifying you are who you say you are. So they will identify you somehow, you know, through identifications. Maybe they want a copy of your driver's license and a W-2 or a pay stub, something to identify you, or maybe a copy, of your uh, passport, something of that nature. And then they also can monitor suspicious transactions. So, and that's through a form called a SAR, a suspicious activity report. And I know a lot about those things because that was something we dealt with at the bank quite a bit. And the threshold is $10,000, even though it can be lower than that. It's really just a suspicious activity report. And let's say you have a uh, a fella come to you and he wants a single premium whole life policy, and he wants the single premium to be $9,999. Well, guess what? You're going to fill out a suspicious activity report. Or let's say he wants to do a single premium for $10,000, but he wants to split the payment up in 2 payments so that it doesn't go over $10,000. Well, guess what? You're going to fill out a suspicious activity report. Now, nothing may happen as a result of it, but the bottom line is you've got an obligation to do it, to do the suspicious activity report. Because if they get in trouble or something is found out at a later date, and they say, why didn't you fill out a suspicious activity report? And you say, well, it was $9,999. They're going to be like, and you didn't feel like that was suspicious, that it was $1 under the $10,000 threshold, and then your butt's going to be on the line at that point. So don't make that mistake. Don't make that mistake. It doesn't hurt anything to fill out a suspicious activity report. The people they don't find anything out about it. They have no idea who did it. I mean, they might be able to figure it out by the process of elimination, but whatever. And then you have the Graham-Leach-Bliley Act. This mainly applies to finance things, but it also applies in insurance. And basically, it prohibits you from sharing your client's financial information. So, basically, to be honest with you, it lets them know that whether you are or not going to share their information, because some companies just do it. And then they provide this to let them know, hey, if you don't want us to do it, you need to go and you need to opt out. Because in your experience, you may have applied for a car loan or some other kind of loan, if it's a mortgage, an equity loan, or whatever. And then the next day after you apply, after you had your credit pulled, you just get hammered with phone calls or letters in the mail within the next week, with a bunch of pre-approved offers or basically the same type of loan that you applied for at your local bank. Well, the reason that happened is because TransUnion, Experian, Equifax, they sold your information. The company that you got the loan through didn't, but the credit bureaus did. As loan officers, what we got used to doing is we started putting false information in the system when we pulled people's credit, because those leads are called trigger leads. Okay, so you pulled the credit, and then basically their information ended up on a spreadsheet, and it triggered. Yes, you will get the reading material as long as you have provided me your email address. I think I've already sent it to you, to be honest. I'm pretty sure you've been on this class before. And then if you didn't get it, please let me know, because sometimes when I send it out to a group, that your email filters it for some reason, because I sent the information to multiple people. Your email provider might filter it, and then I just have to send it to you directly. So if you haven't received it yet, just let me know, and I will send it just to you directly, because I've had to do that about 3 times so far. And in the last 2 weeks, I've had over 300 people in my classes. So, and I kind of been changing things lately. So I've been changing how I send out materials. I've been changing the materials I send out, been trying to do it better and make it, more, what's the word? Yeah. As long as I have your email address in the chat or in the Q&A, which I see yours there, then I will, as soon as this is over, I put your email address on a list. Show you my last list right there, and I copy and paste that into my email, and then I send it out. I send out 2 PDFs, one with life, one with health, and then a link to a video that Justin produced about creating your own study materials. So, and then I know some people that I had in my class are taking their test today. And then I have some people taking it early next week. And then I know I've got some taking it later in this month. So I like to hear from you. So if you save my email address when you get it and you take your test, you can send me a screenshot of your test score. I like to see that. And then it fires me up, when, to know that, what I'm doing is providing a benefit for you. So that's what. All right, cool. So yeah, I'll definitely send it again. I don't know if you were on my last. It doesn't look like you're on my last list, but I'll send it again. And then again, you will get an email. So what's happening is people are getting the email, and then there's just nothing attached to it. The video takes a couple days to go up for review. So, and then again, if you don't get it within a couple days or it doesn't go to your dashboard in a couple days, also let me know that, and then I can email you a link to it. But it will, the one that you attend should get loaded into your dashboard within a couple days. It takes a couple days for them to process it. It goes out to the cloud, and then they add it to the dashboard. So if you've attended both, you'll get both. Should. When was the last one you attended? I recognize your name. Which one were you on? Just let me know. 2 days ago, Thursday. Yeah, okay. Yeah. When it get Thursdays, you likely will go on the following Monday. So you'll get like that one this following Monday, and then this one will probably be out by Tuesday or Wednesday of next week. But you know, these are all pretty much the same, to be honest. So I could try to pull one and attach it to the email that I send out this afternoon. One of my older ones. I need to like think about it and use one that I'm especially proud of. At the end of like I'm very happy with the way today's has gone. Um, and sometimes I get to the end of it and I'm like, oh, what was that about? But today I'm feeling pretty good. So. All right, let's see. I got on late at 2:30. You got your email address. All right, Rosa, I got your email address. And then Rocky, I know. Well, is there really a thing called Ymail? Is that really what it is, or is it supposed to be Gmail? Because if you don't, please review your email addresses. Um, because if you give me the wrong email address, then you're obviously not going to get it. But is there a thing called Ymail? I've never heard of that. But if it is Ymail, that's fine. But if it's actually supposed to be Gmail, then let me know. So, but I know I've had you on my list. You were on my last list. So also check your junk mail because that can definitely happen. I can end up in your junk mail because I know on my end I've sent it out. So, and I know you were on my last one. I think you were on my last two, to be honest with you. So check your junk mail because again, because I'm emailing it from a group with a group, then the most email carriers will automatically think that it's some sort of spam or junk. So, and then I would love to, just send it out individually, but I'm not. I'm way too lazy for that. So I'm not going to do that. Maybe if I put everybody as a blind copy or something, that would work that way. I don't know. So, and then just know that with Graham Leach Bliley, it applies to insurance. Insurance companies have to provide privacy notices. So when you get a privacy notice, I always get these like uh, letters from my financial institutions, and I'm like, oh, that can't be good. And then I open it, and it's just a privacy notice again, and I'm like, whew, and then it goes right in the garbage. So, all right. Underwriting process. So we'll get through this page, and then I'm going to take a quick 15-minute break. And so I haven't seen any responses to what I said. So I'll get through this page, take a quick 15-minute break, and then after that, we will go on until 5:30. and then we'll finish up our day at 5:30. So underwriting, insurable interest. You must, in order to get a life insurance policy on somebody other than yourself, you must have an insurable interest in their life. So again, I use the example husband or wife, parent or child. It could be an aunt or an uncle. It could be a parent that you're taking care of, or just your parent. That's totally fine. I mean, if you're a child and you have an older parent, you don't even have to be taking care of them. They're just your parent. And when they pass away, you're probably going to be the one that has to handle their arrangements. So, again, that being the case, you have a financial interest. So, and then it must exist at application, not at a claim. So, if you, like, say you had a first date with somebody and you thought it went really well, and you think, I'm going to marry this person, and you're like, I'm going to take out a life insurance policy. First of all, that is super weird. And if you are the person, then that's a red flag as far as I'm concerned. If you meet somebody and on the second date they're laying down life insurance paperwork and want you to sign it, then I would consider that a red flag. So, what a weird second date, right? Hey, meet me at the insurance company. I need you to sign some stuff. But you have to have an insurable interest at application. So maybe you do end up marrying that person. Until you have a marriage date set or a marriage license, you don't have a provable insurable interest yet. So, but when you do, then you have the marriage license. As long as that insurance policy happens after the marriage license is issued, then you have an insurable interest. And then there may not be like a physical license, but if you're part of somebody's family and you're part of the family tree, you don't really have to prove anything for that. But I mean, it's there. It's something you can do. That's an insurable interest if you're family. And then medical information, I've talked about this several times. A underwriter can order medical exams based on the application. They want you to go get checked out, get a physical, see how you're doing. They might order a medical information bureau report, MIB. That would be something they would order in order to verify that the information you've put on the application is true and correct. An APS, which is an attending physician statement. They may want literally a letter from your physician backing something up or verifying something that you've said on the application, and then also a consumer report. So probably not going to be like a full credit report. It's probably going to be more of a general credit report looking for, a bad pattern or public records, judgments, things like that, just to make sure that you are, you're likely to pay this account, this life insurance account, even though you're not financially liable to. These companies just don't want to waste their time. Basically they want good clients, and they don't want to be wasting their time because they're busy enough. And then the Fair Credit Reporting Act, that's a disclosure when credit reports are requested. So something that goes out is it's an FCRA report, letting the client know that you did order a credit report on them, and then they have a right to receive a copy so that they know what you based your decision upon. Underwriting process. So risk classification. Oh, I said I was going to take a break. Keep getting further on, and I just want to go ahead and keep going. So I'll get through this page, and then if I remember at the end of it, I'll take a break. You have risk classification. Not much I can help you with here. This is just about learning it. The classification is Preferred Plus, and it's the best health, lowest rates. It's your platinum. You're young, you're healthy. you fall in the right age bracket, you are preferred plus. And then it goes down from there. Preferred, good health. You're generally healthy. Standard, average health. Substandard, higher rates. So your health is not great, but you're insurable. Substandard, decline. Something about your file is an automatic decline. I'm thinking if you are a obese, crack smoking, drunk, you are out. Yeah, Chris, I'll do that. You're a decline. So these are just something you got to learn. And then Stoli, I like this one. This is one of my favorites. Um, Stoli is a stranger or investor owned life insurance. And then this one is illegal, violates insurable interest. Um, so it's basically, you kind of just know somebody and you get a life insurance policy on them. I don't know how this would even work because when you get the insured has to sign a life insurance policy. I guess it would be maybe on a minor. I don't know how this would work. You somehow trick them into signing. I would say this would be more of like type thing where a stranger comes to you, or maybe in the case of a um, loan shark situation where you get a loan from a not technically a licensed financial institution. So they take out a life insurance on you, even though you don't have a legal financial interest. And then if you don't pay back that loan, then you know, if anything I've learned in movies, they whack you. So to get their money, so that would be illegal. That would be an investor-owned life insurance policy, or a Stoli, a stranger-owned insurance policy, and they're prohibited in most states. I don't know of a state that they're not prohibited in, but if I had a guess, it would probably be like New York or something like that. So just know that Stolis go against insurable interest. They're stranger owned or investor owned life insurance company. That's the term. I'm going to go back this page for a little bit. And then it's 4:07. So we have a little less than an hour and a half to go. But I'm going to take a 15-minute break to take care of some business. And then I'll be back to finish out the day. And again, I'm going to, for the last little bit, I'm going to jump over to health for my health folks, unless there's a riot while I'm gone and everyone says, no, don't do that. Um, and cover some specific health only stuff that doesn't have any crossover to life. So really life only people, you wouldn't really get much out of that unless you just really want to expand your knowledge. But and again, like I said, there's health stuff that crosses over to life, but this stuff that I'm going to be going over after the break will not. So, but that's only for the last minute. We did a lot of extra life, so I think the balance is good. So, again, I'm going to now go on break. I'm going to go to and then let me know if I need to go back when I come back off break to that last slide. But I'm going to put my break sign on. We are on a break. Do this. Oops. On this thing. 15 minutes. For 25. Eastern Standard Time. All right, I'm gonna go off camera and off audio for a little bit, and I will see you guys in just a little bit. right, back again. Oh yeah, I gotta erase all this stuff. Stay on the screen if I don't. Probably an erase all, but I don't know it, so I'm just gonna start using those tools. All right, let's see how. Good one, bad one. All right, this is my good one. Check my messages for a second. All right, we're down to 14. That's cool. And we are going to go over some health specific. I'm going to do the first page, and then I'm going to skip over a bunch of pages to get to something that is, I'll just hit the items that are only health related, that they don't cross over. So now, again, as I said in the beginning, if you weren't here in the beginning, I find health to be difficult, even though the more I do this, the more I test well, because one of the things that I do, as far as my job with Just Insurance, is I do quality control on the website. And so I take our tests, our assessment tests, and basically I will go into a specific state, and then I will take the test multiple times. The life test, I'll take it 3 times, the health 3 times, and then the health and life combined 3 times. It takes me a long time. It's not the funnest thing I've ever done. And I will assess how the system is working, making sure that it's giving a good mix of questions and that there's nothing inherently broken. Like, again, one time I found out that almost every correct answer was A. So obviously that's not going to be, it's not going to be very helpful. So we fixed it. And then, so anyway, with health though, it's a lot more just, now with general terms, it is what it is. But with the rest of it, outside of the crossover items, health insurance is just about kind of learning facts. So to me, it's a little bit more like, history, like you're just learning who, what, when, and where, facts, and it's just straight memorization. Whereas life insurance, understanding the need for something or understanding the reason behind something helps you get to the answer. So, what is health insurance? Again, as you're doing this, you should definitely know the definitions of life insurance and health insurance. A contract that helps pay for medical expenses, providing financial protection against healthcare costs. So I think most of us in our lives have had health insurance. So that one is kind of, no brainer, self explanatory. Insured, same as with life insurance, it's the covered person or the insured person. Um, and then the deductible, obviously, life insurance does not have a deductible, but it's the amount you pay before insurance kicks in. So the way that I think most people understand deductible is, we all have car insurance, or if you have a car, you have car insurance. So the deductible affects how much your car insurance is. So if you have a high deductible, your insurance will be cheaper. If you have a low deductible, your insurance will be more expensive. So, usually it's like 500 would probably be considered a low deductible on car insurance or no deductible. And then, $2,000 would be a high deductible. So, meaning before you get $1 paid from your insurance, your deductible is $2,000. So, in health insurance, it's a little bit different. These numbers might be $1,500, $2,500, $5,000, upwards of $10,000 before your insurance kicks in to pay. And then you have something called co-insurance. So after the deductible, it's how much your insurance is going to pay as a percentage after the deductible is paid. So it could be 80-20, which would be pretty good. 70-30, not quite as good. 90-10, really, really good, meaning the insurance company pays 90% of it, and then you pay 10%. And then all the way down to 70-30, where the insurance company pays 70% of it, and you pay 30% of it. And then you have premium, the monthly payment to maintain coverage, same as life insurance. Co-payment, fixed amount for covered services. And usually you find your co-payment right on your insurance card. It will tell you how much you pay for a doctor's visit or how much you pay for prescriptions. Now, there can be other co-payments, for other covered services, but the two main ones that this covers are usually just a general doctor's visit and your prescription drugs. And then your out-of-pocket maximum. So that is the most that you'll pay in a year for covered services. So, you might have a, $5,000 deductible, but and then if your percentage is 70-30, then and you end up in the hospital and you run up $1 million bill or something like that because you had to stay in the hospital for a long time, your insurance will have an out-of-pocket maximum. So the most that you're on the hook for maybe is, say, $50,000, something like that. So, and again, that number, whatever that number is basically going to be the level of coverage or the expense of coverage that you have. So if you have very, very expensive insurance, you pay a lot for it, you probably have a low out-of-pocket maximum, a high percentage of co-insurance. And we'll see these terms here coming up too, because I'll stop on the pages that are health insurance only heavy. So, yeah, these are good to cover right here. These are disability health insurance income policies. So these replace a portion of your income of work due to a disability. So generally they will pay, and this will be the testing question, typically pays 60 to 70% of pre-disability income. And again, that's pretty self-explanatory. If you make $5,000 a month and you get individual disability income, then you will be paid 60 to 70% of what your income was. So 60% of 5,000 is roughly what, $3,000. 70% would be like 3,500 that you would make on disability income to replace your income. And then so this is one that gets covered a little bit later in the content, so I'm going to skip this one for now. But own occupation versus any occupation, it's just a couple of different ways that your disability can be paid. You can be paid based on your own occupation, and you can be paid based on any occupation. So the own occupation is going to be more favorable to you. Any occupation is going to be more favorable to the insurance company. And that's the way the questions are answered. But to understand it a little more fully, we got to go later on in the content. And then there's an elimination period before benefits begin, kind of like what you would have on a job. If you started a job and you had a probationary period for a certain amount of time, that's the elimination period before the disability income starts. And that is typically 6 months, which we saw in the life section. It applies here as well, 6 months. It can be a little different in this application because you can choose your level of disability income, like the policy. You can pay a little bit better on these and get a shorter elimination period. So your benefits may start 1 month after your disability instead of 6 months, but standard general 6 months. And then these are all over the test, is these business, key person, all this stuff's all over. And again, this has crossover back to life. So this is good information. So business overhead expense policy is a disability policy that goes to cover business operating expenses in the event the owner becomes disabled. So, you have a company and the owner is very hands-on and still, he's not an owner by proxy. He's not an owner by, committee. He actually works. I used to work in a machine shop years ago. It was one of my first jobs. And the owner of the company was out on the company floor managing the flow of business. And it was super annoying and he was super mean. And it was a miserable place to work. But the owner was very involved. And if he was gone, now, me personally, I think it would have ran a lot smoother. He's passed away now, so I'm kind of speaking evil of the dead. But I think it would have gone a lot smoother. But from an insurance standpoint, his function would have to have been replaced. So a business overhead expense policy would pay over a 12 to 24 month period to maybe hire his replacement, maybe to hire a temporary person, or pay a person in the company to step over and do his job in the interim while he's on disability. And one thing to keep in mind, this is about to the business. This goes to pay the business. It does not go to the owner himself. So if he wanted an insurance to replace his income in the event of disability, he would have to get a different type of policy, an individual disability income policy. So business, and again, there's some big stuff on this. Very testable when it comes to health insurance. Disability fall under the umbrella of health insurance, selling these disability policies. So in the event you have a partnership type of a business, so you have two business owners, one of them becomes disabled, this buyout would cross over to each. So they would have these on each other, meaning if one of the owners became disabled, the beneficiary would be the owner that wasn't disabled, and then he would use the funds from that settlement or that claim to pay and buy out the other owner. That way the business can continue without the financial hardship of losing one of the owners. It doesn't pay the other owner, except for the fact that it would pay him money to buy out his percentage of the ownership of the company. And this is triggered by total and permanent disability. So he would have to have a probably an attending physician statement saying this guy's disabled, he ain't getting any better, he's got to live with this the rest of his life, and he's no longer going to be able to perform the job function that he currently does. So that's that. And then you have group disability income. So this is employer sponsored disability coverage. These are lower cost than individual policies because they're under the group. When things are underwritten as a group, they use something called the law of large numbers. We will not get to that slide. It's later on. So I always bring it up early because it's definitely a testable term. But group, any kind of group insurance, whether it be life, whether it be health, whether it be disability, they use something called the law of large numbers, which spreads the risk over the group. So meaning you have people in a group generally from 18 in good health to maybe a little older and poorer health. But the younger people make it easier to qualify and help control the costs of this in the situation of an employment type insurance situation, or maybe a fraternal group or something like that. So group disability, employer sponsored disability, lower cost than individual policies, and the benefits are taxable because an employer pays the premium. And we're going to learn those terms here in the next few pages, that if an employer pays, it's a qualified type plan. And if it's qualified and the employer pays it, then the income drawn from it is taxable, because the income on these policies does go to the individual. It's just underwritten as a group, but it's an individual disability policy, and it says lower cost than individual. And what it means by that is the coverage is sponsored by a group. And then because it's, the term would be I just said it and then it escaped me. Qualified, a qualified plan, because it's paid for by the employer. Then the benefits are, and it says typically, and honestly, the reason it says typically is just because, we're not CPAs, so we can't give out tax advice. So we would say consult your local CPA, but for testing purposes, it'll say typically taxable. And then key employee policy, this absolutely applies to life as well. A company will get a life insurance policy or a disability policy like this in order to compensate for the loss of a key employee. Say it's a company and it's the CFO, the chief financial officer. He does everything with the finances of the business. He's irreplaceable. He's got 20 years experience with the company. He knows everything. He knows where all the bodies are buried. So the life insurance policy is on him, and then the beneficiary is the business. The business is the one that draws the income or draws the death benefit from that policy in order to headhunt, find a replacement for that person, train a new person, everything that goes along the lines, maybe give a signing bonus, maybe you have to sign them away from another company, any expense that goes into finding advertising for a new employee, whatever that might be, that's what these policies are to cover. Now, in this case, it's about disability. It doesn't matter. Same concept applies. It says the last one, similar to key person life insurance. In just this case, they're not dead, they're disabled. So they still got to replace them. They can't do it. The business owner is the beneficiary, they need money to replace that person. So, and then just know that business insurance keeps the lights on when people can't. So that's what these policies are meant to cover. AD&D and exclusions we already covered. Okay, this is definitely health only content here, and it's very, very testable. So this is medical expense insurance. So the terms are basic hospital, basic medical, basic surgical. So they all cover different things. But from a testing standpoint, there's generally only one thing that you might see, one or two things. With basic hospital, the main thing that you look for is the phrase daily room limit. Daily room limit. Basic hospital has a daily room limit and then a maximum of days also. So basic hospital covers you being in a hospital or a long-term care facility or a nursing home facility. That's mostly what basic hospital is used for, because these are different kinds of policies here. So this is not your basic health insurance, although these might kick in if you have regular health insurance and you have a longer hospital stay, and your main insurance doesn't cover all of it, then maybe your basic hospital kicks in and pays for the rest. But just know that it has a daily room limit and a maximum days. And then this says it covers hospital ancillary services. That's medicine and food and like possibly toileting, who knows. Ancillary services, that's not going to be tested on. Don't even worry about it. So then you have basic medical. Okay. So one thing that basic medical does is it covers physician visits while you're in the hospital. That could be tested on. I haven't really seen it, to be honest, but could be. So a lot of times if you're in the hospital and your primary care physician has to come over and see you while you're in the hospital, your basic insurance doesn't cover that. But if you have basic medical coverage, it does. And then this also would cover diagnostic services and lab tests. So if you are in the hospital and you need a CT scan or you need an MRI, then those would be covered, but they're subject to dollar maximums. So they'll have what's called a service schedule, and it'll say if you're in the hospital and they say you need a CT scan, they're only going to pay $2,000 for a CT scan, but the hospital charges $3,000. So either you go find a hospital that only charges $2,000, or you just go ahead and get at the hospital you're at and then fight with them afterwards to say, hey, look, I was there already. I was kind of stuck. You did get paid for it. Maybe it wasn't what you wanted. And then, you can write the rest off. A lot of times they already will do that. My wife actually deals with a lot of insurance claims in the job that she's in. And then, doctors will just, basically say, okay, what insurance paid is enough, and we'll write off the rest. And they can do that, and they do it often. And you never even know about it because, how you get so many things in the mail from hospitals and doctors that say this is not a bill on it, this is not a bill, and then you kind of get lulled into this false sense of security, and then at some point they do send you a bill, and then you don't pay the bill because you didn't open it, and then you end up with a medical collection you didn't know about. Well, it's all silly. It's just a bad system. They're trying to fix it, they're trying to clean it up, but I don't see it happening anytime soon. So basic hospital, remember, daily room limits and maximum days. Basic medical, subject to dollar maximums. Special services or diagnostic services or tests are subject to dollar maximums. And then basic surgical, the question generally will be that it uses a surgical schedule of benefits. Same thing we talked about, the schedule of services. This is a schedule of benefits, meaning they assign, the insurance company says you need an appendectomy. We pay whatever, 3,000, 5,000. That's probably not right. $5,000 for an appendectomy. But then the doctor or the hospital, their appendectomies cost $7,000. And again, you end up in that same cycle where the hospital can say, okay, well, the insurance paid us 5,000. That's enough. We're good. Or they can go after the patient for the remainder of the money that they charge for it. And then also, basic surgical might include anesthesiologist or an assistant surgeon. So if you've ever gone to the hospital for anything, you you'll get a bunch of different bills. You'll get a separate one. Like, let's say you had to be taken by ambulance. You'll get a separate bill for ambulatory care. And then you were in the emergency room. You'll get an emergency room bill. And then you ended up having to have surgery. Then you'll get your surgery bill. And when you had surgery, you had to be put under. You get a separate anesthesiologist bill. And then they all, will send you letters for 3 or 4 months that says this is not a bill. That's when they're all working out what the bill should be. Ultimately, they're fighting with the insurance companies. They have people on the inside working on getting as much money as they can from the insurance companies. And then at the end of the day, either they end up taking too long to file the claims with your insurance company, and so the money automatically gets written off just because they didn't have enough time or manpower to do the insurance, because there's very strict laws about when things have to be filed. So that's all that. Oh, this is my favorite section. Hold on. I gotta get a drink. It literally is, when it comes to health insurance, it's my favorite section to explain. Just because I think I have such a unique grasp of it that I can help you learn it. In the interim here, I gotta make a drink because my throat is dying. So this is where you get into the really, really health insurance medical nitty gritty. So you have 4 different things here, basically. You have what's known as major medical policies. So typically, these are going to be your mega high deductible with co-insurance provisions. And what that means is a HSA or FSA. And we'll get into that on the next page, I believe. So a flexible spending account or a health savings account. And it's basically you're building that account up to pay for the super high deductible on your major medical policy. Now, what these are is cheap. They're cheap because they don't pay nothing. A lot of times they don't have drug coverage. This is just like worst freaking case scenario. Or let's say you're working for a company that doesn't really pay for a whole lot of the health benefits, but you want to have something. So you take what's known as I would call it the bronze plan, probably. The cheapest one on the list when you're picking it out. Maybe, I worked for an employer that, for the family plan, it was like, $600-700 a paycheck for a family plan. But if you chose a bronze plan or major medical, it was like $150. Well, obviously the coverage was crappier. And then you got a FSA or an HSA to supplement that. and it was money that you put in, possibly money that the company would put in, because they were saving a lot of money by you choosing that plan. So they would gladly throw money into an HSA for you, and then that would go to cover if something happened. You'd have that money, to pay for your high deductible or your medicine or whatever treatment you needed. Maybe pay for your MRI or CT scan that your crappy benefits didn't cover. So again, high deductibles, co-insurance, meaning co-insurance, meaning an FSA, a flexible savings account, or an HSA, a health savings account. And then they had lifetime maximums, but they don't have those anymore. The Affordable Care Act did away with the lifetime maximums. This is still tested on. This is how it's tested, is that a major medical policies used to have lifetime maximums, but that's now prohibited by the ACA. So generally how I see it is major medical policies once had lifetime maximums, but are now prohibited by the ACA. True or false? True. Or lifetime maximums are now prohibited on major medical policies due to the ACA. True. That's true. All right. And the thing that always trips people up, or can trip people up in a bunch of different applications, is HMOs, PPOs, and POSs. Most people haven't even heard of POSs. Not the POS you're probably thinking, totally different. But an HMO, and I will give you some help as far as helping you learn these in a way that will help you understand them. So an HMO stands for a health maintenance organization. I got nothing for you there. Just got to learn it. Health maintenance organization. But there is some aspects of it that will help you remember what the acronym actually stands for. So, which is the word maintenance. Sorry, there's something I just thought of that I want immediately and I can't find it. Doggone. So anyway, health maintenance organization, or HMO. If you've ever had insurance, you've heard of HMO or PPOs. So a health maintenance organization requires a PCP, or a primary care physician. So you have to have one, and if you ever go into a situation, health situation, and you provide someone your insurance and they immediately start asking who your primary care physician is, then if you didn't know before, you know now that you have an HMO. So that's what's telling you you have an HMO, is that they're asking you, and they're adamant about it. Like, who is your primary care physician? We have to know. Well, that's because you have an HMO. And then in order to go to a specialist, say like an ankle doctor or an ear, nose, and throat doctor or something of that nature, you have to have a referral from your doctor. So that's another thing. If you ever get into a situation where you want to go to a specialty type doctor, one of the, like an ear, nose, and throat, or an ankle doctor, or a dermatologist, something of that nature. I see your email address there. Thank you. Then you have an HMO, because they require referrals for specialists. And then health maintenance organizations, network-based care only. So if you want your insurance to pay for anything, you have to stay in network. They are adamant about that. I mean, there's no wiggle at all. Network-based care only. And then emphasis on preventative care. What is preventative care for your car? Oil changes, filter changes, lubrication, or other words, maintenance. So an HMO, a health maintenance organization, emphasizes preventative care. Well, what's preventative care? Seeing your doctor on regular intervals. If you, if I have an HMO, so, and I feel like I am at my doctor every 2 months, and I think I am, and I have high blood pressure, and it we've been working on getting it under control. So, and we're doing pretty good now. And but they want to see me constantly because they are all about preventative care. So that's an HMO. And the opposite, or the other version, is a PPO, or a preferred provider organization. So you have, like, where HMO is network-based care only, you've got to stay in their network. You have no choice. This is where, if you remember, if you were alive or around when the Affordable Care Act was put in, a big opposition to it was people said they're going to lose their doctor. And the politicians came out and said, nah, no, you're not going to lose your doctor. That's a lie that the other guy is saying. So the other guy is saying you're going to lose your doctor, but you're not. We promise. But they lied. You absolutely did, because the ACA was very heavy on HMOs. So the majority of ACA health policies were HMOs. So they, in other words, all these people that thought, well, we're going to be able to keep our doctor, that's what they told us, and then they're like, no, we're forcing you to get an HMO. You have to change doctors. You have to go get an in-network doctor. And so, did they know they were lying? Probably. Either that, or they just fundamentally didn't understand what they were doing. Well, what does that mean? Well, they probably shouldn't have been messing with healthcare because they didn't know what they were doing. So, and then also they provided a 900-page bill, and they gave people less than 24 hours to review it before the vote. And they voted in the middle of the night. There was a lot of things messed up about the ACA. There was a lot of good things that it had in it, but there was a lot of things that weren't so good. And I don't know, since it's been enacted, I don't know about you, but if healthcare doesn't seem to have gotten more affordable. It just hasn't. So, preferred provider organization. You have a network of preferred providers. They don't make you. You can stay in the network on a PPO, preferred provider, but they don't make you. So what they do is if you choose their in-network providers, they give you better benefits. They pay more for those in-network providers. But remember, the word is preferred to help you remember. You can go see out-of-network providers. You're just going to pay more for it. You can go to your preferred provider. You're not stuck in network. So that's why it's the opposite of an HMO. And then for specialty services, you don't have to have a referral. So if you feel like you need to go to the ankle doctor, you can just walk in the front door and go to the ankle doctor. If you, again, feel like you need to go to the ear, nose, and throat doctor, you can just walk in, go to the ear, nose, and throat doctor. You don't have to have a primary care physician tell you have to. So that's major medical, HMO, PPO. So if you grasped all that, you have a greater understanding of what those things are. And then the next one would be a point of service plan, which is a hybrid. It combines HMO and PPO. And these are rare because, these would be your Cadillac plans, your platinum insurance plan. I've never even heard of one ever in my entire life. And again, I've had all kinds of different jobs, all kinds of different, employer sponsored health plans. and I have never seen a POS. So I've never seen a point of service plan. But it would be your platinum, very expensive. That's, I mean, the companies just aren't going to pay for it. Maybe that's what they have for their executives or their, their higher ups. They have a point of service plan. Um, so the main thing that's different about a POS as opposed to HMO and a PPO is you do have to have a primary care physician with a point of service, but they can refer out of network. So they have to uh, give you referrals for specialists, but you can go out of network. Um, so it's the best of both worlds, a POS. So that's the main thing that it combines. So the test question would be, what type of insurance plan combines the best features of HMOs and PPOs? And the answer would be a POS or a point of service plan. And these are what I was talking about. These go with major medical. So this co-insurance provision right here with these high deductible major medical policies. So you might, you might have a medical plan that you choose at work and you'd be like, oh, well, it doesn't have an HSA. I really want an HSA. I like them. I love, health savings account. They're awesome. But if you have a PPO or an HMO, you don't get the option to have one because you have to get a major medical policy in order to get access to. I don't know if that's always the case. Maybe some places offer them, but the main reason that these are all used is because they supplement a high deductible major medical insurance policy. And now, if you didn't understand the difference between an FSA and an HSA, now you're going to. And I lived in that world for a long time. I had no idea the difference. And I would walk into a pharmacy or whatever, and I would pull out my FSA card and I would show it to them. They'd be like, this doesn't work here. It doesn't work for this. There would be limitations on it. And the reason why, it's because it's called a flexible spending account, but it's not really flexible. It's kind of an oxymoron. So it's an FSA is pre-tax dollars set aside for medical expenses. So you do get a little card, but generally, if you're using it at a pharmacy, it's only going to cover the copayment on your drugs. Or if you, again, are going somewhere for some sort of elective surgery or something, you can use it for that surgery, again, or to pay your deductible on your high deductible health insurance plan. And they have a use it or lose it rule with limited carryover. So, meaning at the end of the year, whatever money was in there, it's gone. So a lot of times people will go in and you can kind of look on the shelf and see like things that you can buy with an FSA literally listed on the tag. If you look on the shelf at a CVS or a Walgreens, it'll show you like, hey, this is FSA eligible or this is HSA eligible. And then you can use your benefits at the end of the year. Maybe there's some certain vitamins or something that are FSA eligible, so you load up on those vitamins. I don't know. That's just an example. And then you have HSAs, which actually are a lot more flexible because it's your money. Okay, so these go with high deductible health plans, HDHPs, and then the minimum deductible requirements are 1,400 individual, 2,800 or family in 2023. To me, anymore in 2025, that's not that high of a deductible, to be honest. Like, it doesn't look too out of whack for me because things have gotten so expensive. And based on that, based on the consumer price index and inflation and things like that, those numbers may move. Those numbers might get changed and go up. But with these type of plans, they allow you to get a health savings plan. And so you put money into a health savings account. Oftentimes, your employer matches those funds, like on a 401k or something. And HSAs are what they call a triple tax advantage account. So not only are they tax deductible at the end of the year, the money that you put in, or they're tax deductible from the standpoint of they come out of your pay pre-tax, so you don't pay tax on them. They grow tax-free, so they're in a savings account. So while it's not big, you're not going to get rich off of it, but the money does grow. And so as your HSA account, if you don't use it for a while, grows, it's going to get larger and larger, and it's going to compound interest. And then when you take it out to use it, you don't pay any taxes on it even then. So that's why they call it a triple tax advantage. I always like that term. It's a triple tax advantage plan, which is what an HSA is. It's a health savings account. A lot easier to use it. A lot of times if you go to a pharmacy and you get your prescriptions and you go to the counter and you put other things, say a drink and a snack or something like that, or whatever else it is you want to buy at the pharmacy, and you use your HSA account, it's going to go through. It's going to cover it. So HSA, it's your money. It's a savings account. So it's your money. And then the funds roll over year to year. That account keeps growing. And then the customer owns the HSA account. So a lot of times if you have an HSA and you leave a company, you will get a new card in the mail with the remainder, the balance of your health savings account funds, because it's your money. And it's the only triple tax advantage account in existence. So I'm a big believer in HSAs. And then here's something called an HRA, which is a health reimbursement account. I had one of these at one of the companies I worked at, basically a health reimbursement account. So basically what you would do is you go get your services. Mine was dental. So I would go get whatever I needed done dental wise. And then the company would send a bill to the employer. And then the employer would pay the bills and they would establish their limits. And for dental, I had $1,500 annually that I was able to use. And we were a smaller company. So basically the boss didn't have to invest in a big insurance plan or buy insurance for his employers, but he could provide that as a benefit for him. And it was much more flexible on how you could use those funds. Whereas if you have traditional insurance, they're going to be very specific on how and when you can use them. You know, they didn't roll over every year. They just reset 1,500. So, you know, if you got to the end of the year, you'd go get a cleaning or get your teeth whitened or whatever. And then your health reimbursement account would pay for that. But the employer is the ones that owns the account, and then it's up to them whether the funds roll over. But the testable question on an HRA will be generally, or most of the time, is going to be the employer owns the account, a health reimbursement account. It's a self-directed health reimbursement account where they pay your medical expenses. Oh, this is where it gets fun. We're at 5:15. We'll wrap up at 5:30. You know, this page, and we might make it to the end of the next page, possibly. But Medicare supplement policies, we might just make it through. Generally, within a couple days, The recording will be loaded to your dashboard if you've attended. If you don't, put your email address. If you haven't yet, put your email address in the chat or in the Q&A, and I will send you out a link to the recording. I actually just got an email when I was on my break from someone saying they haven't got it yet, and they were in my Tuesday class. So I will send them a link to the live, and you can use that if you get to the end of the night and you're having trouble falling asleep. You can fall asleep to my silky pipes. So, but you know, that's just an added benefit. And also, this content can get pretty dry, so it'll help you. You won't need melatonin anymore. You can just have me. So, used to be my mom used to listen to radio at night, and there was a radio talk show guy, and it was called Night Sounds, and he had a real smoky, deep voice. And the longer I talk, the smokier and deeper my voice gets. So I sound like the Night Sounds guy. And then he would play smooth jazz to help you go to sleep. And so yeah, so that's me. I can't remember the guy's name, but it was probably like the Pope. They probably had a bunch of Night Sounds guys, you know, and then, you know, the one would die and they would just replace him with a new guy with a deep smoky voice. So anyway, we're gonna make it through this page barely, so because I've talked too long with the nonsense. So Medicare supplement policies. One thing I'm going to tell you right now is I'm going to warn you, if you're just getting your healthcare license, and or if you're getting your life health, healthcare companies, Medicare supplement, they will drain your life away. Now, I'm not saying they're not good to work for, because they're one of the kind of more unique, like, insurance companies that's more like a traditional job as far as you know, W-2, base salary plus commission, things like that. Benefits, you know, health benefits, but they will wear you out. Like right now is open enrollment for Medicare supplement policies. So during open enrollment, you will work, I mean, nonstop. You will be tied to a headset. You know, it will feel like a ball and chain, and you'll make maybe $20 an hour, maybe upwards of $25 an hour, probably more like 20, and then X amount of dollars per Medicare supplement policies that you sell, probably 150 bucks. And that sounds awesome. And it is, to a point, because Medicare supplement policies are like shooting fish in a barrel. You know, you get that lead, and it's, you know, 65-year-old Martha and or 62-year-old Phyllis, and she's getting Medicare for the first time, and you want to sell her a Medicare supplement policy. And so you might sell through United Healthcare, you might sell through Cigna, whatever, you know, all these different companies. And most of the time, the premium is going to be $0, and they're just going to have some sort of a different benefit. So keep in mind, these are Medicare supplement policies, and I'm going to, as I go through this, I'm going to explain more about the pitfalls of selling Medicare supplement policies. Now, I'm not saying it's not a good job. It's a good job, and it can pay well, and you can do it on your own. You can be an independent Medicare supplement policy salesperson. But I'm gonna give you a big warning on that before we're done. So this fills in the gap. So original Medicare is part A and B. So if you help your mom with her, or your parent with her health insurance, you take her to the doctor or whatever, and the doctor says, hey, can you make a copy of her insurance card and send it over to me or something like that, and you snap a picture of it and it is red, white, and blue, and there's an eagle in the middle of it, that is Medicare Part A and B. That's basic or original Medicare, because a supplement policy will be with a private insurance company. They will service it. This will be like a United Healthcare or a Sigma. And there's another one that I can't think of the name right now. There's tons of them. Again, there's supplements. These cover deductibles, coinsurance, and copayments. So these manage through Medicare and add things to Medicare, basic services. They cannot duplicate Medicare benefits. So you can't have basic health coverage with Medicare supplements that have coverage that your Medicare already has. So here's your question and answer for the testing purposes, is that with Medicare supplement policies, can you duplicate Medicare benefits? False, or no, you cannot. So key features: the standardized plans are letters A through N, and they all do different things. Okay, so again, this is a broad overview. There's a lot more in depth. Like down here, it has A, F, G, N. All right, so it's A through N, but the one that's not on my content is C, and C covers dental and vision. There's a Medicare Part C or Plan C, and that way you remember it is it's vision, so C. And then Medicare supplement policies are guaranteed renewable. So if you choose one when you're 62 and you don't do anything at open enrollment, then your whatever supplement you have, it's just going to renew. Now, if you want to change, or if somebody wants to change, you're talking to somebody and they already have a Medicare supplement policy, but you find out that you have one that provides $150 worth of groceries for that person. And these exist. It actually exists, but they don't have that. And the premium is $0. So it's not going to cost them any more money, and they're going to have grocery coverage, and they need that. So you change their policy. Well, that's good. That's a positive thing. But that's their original would renew, but you can change it. Like as the salesperson, as the representative for the company, you can find them better coverage. Now, again, you're subject to a free look period and things like that. You have to be benefiting them, especially when it comes to elderly people's health coverage. You don't want to fool with that. And that's where the independent stuff gets a little dicey. Like I said, I was going to do this for a while. I was working with a guy who is an independent Medicare supplement agent, and so I was going to kind of go learn the ropes from him and try to do this on my own. And I said, yeah, I got this idea where I'm going to like rent out the county's like, township hall and have seniors there and then sign them all up. And he's like, whoa, cowboy, you can't do that legally. You would get in so much trouble if you did that. Now, even though you did it electronically and all this kind of stuff, you did it the way it should be done. You're sitting there, you're helping them, you're going through the application with them, literally on your phone, taking the information from them, which they might struggle with on their own. That's not legal. You can't do it. It has to be done independently. over the phone, and then they have to do their own application. You can walk them through it, but then they have to, again, they have to finish it. They got to complete it. So are you getting it? I don't know. I'm assuming that. I'm not speaking from a good experienced, but he scared me. Let's just say that. And he scared me that it's got to be done in a certain way. That's why I generally recommend, if you're going to do this, you probably want to start with a company first, learn all the ins and outs of it before you try to be an independent Medicare supplement policy agent. Now, once you know all the ins and outs and you're comfortable with it, hey, have at it. But because that would be, an awesome life, because as opposed to making 20 bucks an hour and $150 to sign people up, a Medicare supplement policy pays $500 or $600 each person that you sign up. Now, again, if you're doing it on your own, you've got to generate your own leads and figure that out. But if you somehow, can do 10 policies a week, which I think is very attainable, you make 6,000 bucks in a week. And if during open enrollment, which is like a couple months, you might make, I don't know, whatever, $30,000-$40,000 during that time, and then you go back to only selling just a few policies a month the rest of the time, and then you kind of like, um, everything else is like, what's the word? Because they can change during the year, and then it would be like referral based. So you're dealing with Ethel or Martha, and they're their senior Saint Center, whatever, at a thing, and they talk to their friend and say, hey, I get groceries with mine, and they're like, well, I need that too, and well, here, talk to my agent, and then you would get a referral, and you could sign people up. Now, you're not going to sign up as many people outside of open enrollment, but you can. So guaranteed renewable. And then another big thing is 6-month open enrollment when you're first eligible for Medicare Part B. That is 62 years old. When you become 62 years old, you become eligible for Medicare Part B. And during that time, you can sign up for any medical supplement, Medicare supplement policy that you want. And there's no medical underwriting during that original open enrollment. So that's important. And that's where we're gonna end up. We got about 2 minutes, but you can go through this stuff. I'm gonna send you over the content via email, but I have maintained my voice. Sometimes I'm really, really dragging. It sounds like chain link being dragged over gravel by about the 8th hour. But I appreciate you guys being here. I will jump right off here, grab emails, email addresses, send you over PDFs, a link, and then hopefully in a couple days, if you taking the test soon, please keep my email and let me know when you pass. You can send me a screenshot or just say, hey, I passed. And I love to hear it. And you can let me know if my words rang out. Can't remember if I did this earlier. Yeah, that's fine. Yeah, I'll go through. Now, if I'm not paying good attention and I just send you the email and you get the email twice, don't yell at me, because I'm just, especially the more I get, because I've had as many as like 30 or 40 in here today. So we finished with about 13. But I appreciate you guys very much. Good luck. And then I hope, my voice rings in your ears with the right answers as you're taking the test. And again, I would love to hear from you after you take your test. When you pass, we're going to be positive and say, when you pass, you're gonna let me know that. And again, good luck with that. And thank you all for being engaged and listening. And it was awesome, and I appreciate it. And I'll send that stuff out to you. So have a great rest of your Saturday. Go do something fun. I'll be on here for a little bit, but I'm going to turn the recording off and all that jazz. Pause. We're going to stop recording. So I'll be monitoring, but I will be